Hello everyone, good morning. Welcome on this fine Sunday morning today, 20th December. Uh, what a fantastic time and what a fantastic event today that we lined up. We're going to talk about one of the most critical aspect of our auditing. And today I have with me the chairman of our WIRC, C. Lalit Bajaj, the dynamic central council member and the chairman of the FRRB board, C. Aniket Talati from Ahmedabad is with us. So welcome. Anand Bhai Jagotia, the treasurer of WIRC is with us. Anand Bhai, welcome. And our Kar Niti expert, the GST guru, C. Umesh Sharma, has also joined us. And our vice chairman, right from while he's traveling from Ahmedabad to Baroda, on the way, on the go, he has joined us also. Welcome, Vishal Bhai, and thank you for joining us again on this lovely event. We also have with us the coordinators Sheetal Madam and Ravi Kumar ji with us. To start off with, I'll first invite. I want to take this moment. I want to take this entire event that we've lined up today for multiple things and a very critical, a journal or a very critical publication. Keeping in mind, keeping in line with the vision of our chairman is what we would want to unveil today. I would request our chairman to please share his vision and his opening address for this session. Over to you, Chairman Lalit Bajaj.
Thanks, Arpit. A very dynamic Central Council member, C. Aniket Talati ji, with whom we have worked at Regional Council also. And he is as an inspiration for all of us as far as working at WIRC is concerned. My co-regional council members, Umesh Bhaiya, Vishal Bhai, Anand, Arpit, coordinators, Sheetal, Ravi, the contributor for the publication, seniors, members and friends. On behalf of FRRB and WIRC, I welcome all of you in this August gathering, wherein we are supposed to discuss various aspects of financial reporting, aspects and analysis. At the outset, I would like to thank CA Aniket Talati, heading FRRB at ICAI, for really being kind enough and at the same time purposefully and ensuring that let us plan this program for the benefit of members at large, because he is very much concerned as far as financial reporting from various for various stakeholders and from various professionals is concerned. So on behalf of WIRC, we thank you, sir, for giving WIRC this opportunity to conduct this wonderful event. As you all might be aware about FRRB, historically it was started in 2002 with the purpose to review and ensure the compliance of generally accepted accounting principles and other generally accepted principles which we follow as far as financial reporting is concerned. We have to take care at ICAI and at various forums of the institute the interest of various institutions, various stakeholders, various interested parties, whereby we have to ensure that we can achieve the benchmark of best reporting standards. And I think so FRRB is coming out with really very relevant publications periodically, ensuring that some of the very important and pivotal areas are properly covered for the knowledge of the members at large. Through this forum, I would request all the participants to go through the publications announced by FRRB so that we all are really enriched and updated about the various provisions. I would like to compliment the team behind coming out with the publication on technology industry. Let me share with you, friends, the team who has worked on this e-publication has toiled for last 1 month and ensured that this publication can be of best use for the members who either are working with this industry or are working as a consultant with these industries. Very handy publication, will be freely available on WIRC website to be downloadable at any point of time. I would really like to compliment our treasurer CA Anand Jakotia, CA Umesh Sharma, who have been pivotal in ensuring the logistics of this specific publication. Contributors Ravi Somani, Nilesh Khandelwal, Chandrasekhar Sarda, Chandan Lahoti, Saket Rathi, Gokul Rathi, Arpit Sodani, Manoj Malpani, Anket Dodia, Shubham Charkha, Sachin Parkale, Karan Chandwani. We are really thankful to each one of you from bottom of our heart for helping us in taking ahead our initiative at WIRC, whereby we are seriously working on some of the very relevant and important publications, and this is one step ahead in that direction. uh, there are various other initiatives taken by WIRC. I believe you all might be visiting WIRC website and WIRC newsletter, whereby you might be updated on the various initiatives and activities of WIRC. Do participate, do contribute in all the initiatives and activities of WIRC, and enable us to engage into more and more such kind of activity in near future. With this, I once again welcome all of you and thanks CA Aniket Talati, our Central Council member, for being with us in all our activities and initiatives at WIRC. Thank you.
Thank you, Chairman sir, and congratulations. Indeed, a very, very sought after and a very, very thoughtful publication here. And believe me, friends, are the essence of this entire event, the financial reporting. I think most critical aspect of a chartered accountant, today is how are we reporting effectively, given the rise, given the changes in the economy, and given the dynamism of IBC that has come in. So I think therefore this session becomes very important, and with Aniket sir with us, I think it would be of immense importance. But before Aniket ji, I could invite you to dwell on this session. I would request in your August presence, if we could inaugurate this publication, I would request our treasurer Anand Jakotia to please take the proceedings and inaugurate this lovely publication on technology sector in the August presence of our CCM Aniket Talati and Chairman Lalit Bhai. Over to you, Anand.
Yeah, thank you, Arpit bhai. Respected participants, my dear friends, thanks, sir, for being here on Sunday morning, and special thanks to Aniket bhai, Chairman FRRB, Young and Dynamic Leader at the center. And Aniket bhai, thanks for allowing us to launch this e-publication. Friends, our dynamic chairman Lalit bhai had many agendas, and out of those people publication, we wanted to have many publications which will be useful to members in industry and in practice both. And one of the publication agenda sub agenda was having several publications. So we had a publication on logistics. We launched that earlier. Afterward, we launched a publication on hospitality. And today, third e-publication sector-wise, e-publication on technology we are launching, and so many contributors now work on it. Special efforts by Umesh Bhai, ex-vice chairman WRC, and the team was led by Ravi Somani, renowned ESG expert, supported by Karan Silwani, Kundan Lauti, Chandrasekhar Sarda, Nilesh Khandelwalji, GB Rathi sir, Manoj Malpani, Saket, Sachin, Ankit, Pooja, and this publication covers all the relevant aspects: direct taxes, indirect taxes, accounts, keeping, as well as information technology act is covered well, and future of this sector, as well as opportunities for chartered accountants are covered very well. So even if someone gets new client in this sector, this publication will be very much useful, whether it's auditing practice or management consultancy, as well as for industry people. So superb efforts, Ravi bhai. Congratulations to the whole team on this launch, and I request Aniket ji and Lalit bhai to please do the honors. Please speak towards Aniket sir.
Congratulations, Anand. Uh, Thank you for unveiling this publication. Thank you all the contributors for, as Lalitha mentioned, toiled day and night. And today being a Sunday, our chairman and even our central council, Aniket, both of them are in the institute. and they are dwelling upon a very critical aspect again, the forensic audit standard. So, thank you, Aniket, for your time. I would like to quickly move on with the session. The first and foremost, financial reporting, regulatory perspective, certification, one of the most important part, projected and provisional financials. I would request Aniket Bhai, and I would briefly introduce him. Man of refined thought process, quick understanding, and sharp vision. Aniket Bhai is a Central Council member, as we all know, and he's from Ahmedabad. He's also respected for his strong organizational skills and deep insight in the affairs of profession. He has a very affinity towards reading and reads a law, interprets law, is fond of reading these laws very effectively, and therefore he comes from a very strong background of understanding these affairs of the profession as well as the various perspectives that can come over for a CA. He heads the consulting vertical in his firm Talati and Talati, one of the largest firms of Gujarat, has led an engagement of over 20 CAs to New York. He's a Master of Commerce and has done articleship from Lovelock Lewis, has developed a unique perspective to look into the matter. He's also the chairman of FRRB, and that is why he's conducting this session today. In that capacity, a convener of Digital Reengineering and Learning Directorate. He's also serving on Board of Studies, Digital Accounting and Assurance Board, one of the most important board driving the digital revolution in ICAI today, the SSP and everything that we look today as Accounting Standards Board, Auditing and Assurance Standard Board, Direct Taxes Committee, and also the Executive Committee of member of Gujarat Chamber of Commerce and Industry. I can go on and on about Aniket Bhai, the dynamism that he brings on table, and the screen itself gets lightened up with your presence, Aniket Bhai. But moving ahead on the session, I request you to please carry on with your views and please guide the entire audience today on the most one of the most aspects of certification and provision reporting that we do. Over to you, Aniket Bhai.
Thank you so much, Arpit Bhai, for the warm introduction. I think I'm definitely not worthy of all the praises, but I'm glad to have all the love and affection here at WIRC from all of you. First of all, led by the first person of our profession in the region, our leader in West, Lalit Bhai. Thank you for hosting this. I'm extremely glad that this is the first event that FRRB is hosting in the year. We had a national seminar, but which is being hosted by some other region or branch. It is the first, and I'm glad it is being done at WIRC under the aegis of the Western region, as Lalit Bhai is the chairman, Vishal Bhai, the vice chairman, Arpit ji, who's present here. Great to be with you, Anand Jagotia ji, Umesh Bhai, whom also I had the pleasure of being in the regional council along with Lalit Bhai in the last term. And it's great to have all of you, and thank you for inviting us for hosting this event. I think a very important topic session. I think the whole day we are going to dedicate to understanding our common pitfalls. All of us in our practice, we were doing maybe just GST work or tax work, but somewhere it is the financial statements that is the base for doing our GST and income tax work. And many times what we are noticing at the FRRB is very common pitfalls, errors which are easily avoidable, which we at the FRRB are commonly trying to make aware through various publications. We have publications already issued, for example, on the erstwhile accounting standards, which are applicable to smaller companies, partnership firms, proprietors. Those have been issued. Now we are going ahead the first time in the world, I'm proud to say, with a publication on common errors in India's financials, which is effectively the IFRS Converge standards. You will not find a parallel of this publication anywhere in the world. And again, the idea is that we can make our members aware that these here are the common errors or mistakes in accounting standard implementation, in financial statements, in audits that our members are making. And the idea is that we can then bring them alive, make our members aware of all the errors, so that at least in your practice going forward, you are not making these errors. The way we have designed today's structure, and I'm happy to share with you, is that for the first couple of hours that I have been assigned, I will be taking you through the common errors, or rather the common questions that members have in regards to certificates. That is, what are the certificates that are issued? Of course, these are not being reviewed by the FRRB, but a very common question that people ask. Provisional financial statements. Chartered accountants in practice often come across this dilemma that they are the auditors, but yet for banking or other purposes, the clients come to them and ask them to issue a provisional financial statement, that please issue a provisional balance sheet, please issue a provisional P&L account. Your audit may become due in September, December, whenever it becomes due based on the deadline. But sometimes in April or May, the client requires you provisionals, whether those provisionals can be issued or not. And more importantly, certain banks require projected financials. What will be the year 21, 22, 23, the balance sheet and the P&L? Can we as chartered accountants sign these? So I thought that is an appropriate topic, that though we are dedicating today's day under the aegis of FRRB, we should also discuss certain standards that are already in place, commonly referred to them as audit standards. But as we will learn in today's session, it is the entire gambit of engagement standards, which not only covers audit and review standards, but other assurance engagement standards, related service standards, and other guidance notes that the institute has come up with, which are extremely important and critical for the implementation of financial statements, rather the audit of financial statements, the opinion on financial statements, and the preparations. Because let's not forget, even at the preparer's end, for large companies and others, the person on the other side is also a chartered accountant and a member of the profession, and therefore extremely important that not only we as auditors are aware, but through this medium, when all of you are present in such a large number and attending this seminar, even the preparers of financial statements or people who are demanding these certificates or otherwise are made aware of the regulatory provisions with regards to these. So very grateful and thankful to WIRC. I think they're doing a phenomenal job this year with the number of events that they have been able to do, with all the virtual platforms that they have been able to use. Initially, they were not with the CPE or structured CPE hours, but then they were able to have sessions which were with structured CPE. They did the certificate courses, they did the refresher courses on direct tax and others, which have been a huge success. So my compliments to the entire team of WIRC led by Lalit Bhai for taking up these initiatives, for ensuring that the members, even in these tough times of pandemic, are updated of the regulatory provisions, of the changes in laws, and more importantly, stay connected to the institute. So friends, today's session is going to be dedicated on certification, projections, and provisional statements. The second session is going to be taken by Khushroo Bhai, which will deal with common errors in Ind-AS financial statements. Again, like I said, we are coming up with a publication on this, maybe sometime later this month or early January, which will deal with the errors that the FRRB as the board has noticed on Ind-AS financial statements. And the question that may arise is, how does FRRB publish these, or where is the source of these common errors for the board? And let me share with all the participants here today, as chairman of FRRB, that it is the role of this board, which comprises of myself as the chairman, say Babu Ibrahim from Kerala, who's also the vice chairman, and other members on this board, who on a monthly basis have the board meeting of this FRRB and look at financial statements. Based on the financial statements that are reviewed, the common errors that were noted are then put in the form of a publication and also in the form of this presentation. The process of FRRB, if for the benefit of everybody we were to discuss, is a very simple and a transparent process. Every year, some 50 to 100 companies are selected by the board, and this is a very transparent, randomized process where we do not look at which are the companies that are being selected. They are done on a very transparent basis, without knowing the names, on a numbered basis. And once the selection of companies is done, these financial statements are first handed over to a technical reviewer. A technical reviewer is a chartered accountant with sufficient amount of experience, understanding of not just accounting standards, reporting and assurance standards, but also understanding of the Companies Act, the Schedule 3 and the CARO requirements. And they look at this financial statements, compare them with the relevant standards, and then if there are errors that they are noticed, they are tabulated. This report is then referred to what is an FRRG, a Financial Reporting and Review Group. The group then looks at all the non-provisions or non-compliances or deviations that are identified by the TR, comments on it, whether they agree with it or not, and if there are any additional findings, they also submit that. This is then received at the FRRB level, and a team of technical experts within the board looks at it for a third level review, and then presents it to the board. And the board does the final 4th level review, which then determines whether the company's financial statements and the job of the auditors has been done as per the expectation, that is as per the standards. If, for example, it is found that there are material deviations, there are non-compliances which are of material nature, which impact the true and fair view of the financials. In such cases, the board has to take a decision to refer these matter to the disciplinary committee. And let me tell you, friends, this is not that every case gets referred to DC, but those where it is found that there are pervasive material non-compliances, where the true and fair view, in fact, has been impacted, and maybe the auditor has not been able to do his, in the opinion of the board, his task correctly, then those matters get referred for disciplinary action. But if there are non-compliances, but the board feels that these are not of that nature which require the director discipline to look at it, then an advisory is issued. So there can be 1, refer to disciplinary, 2, matters which are taken up as an advisory and sent it to the auditor, or 3, if there are not many errors, then those are only referred within the board and kept as such. So the board has a very active role to play in terms of reviewing financial statements from the public domain. Like I mentioned, the selection is done on a suo motu basis in a transparent manner. The board also selects certain cases which are referred to it by the institute mechanism for cases which have a huge public impact or bearing, which have been reported to the newspapers, and those are also reported by the FRRB. So the role, my dear colleagues, that I'm trying to tell you of the FRRB is to ensure on a test check and sample basis to select financial statements from the public domain, from available general purpose financial statements which are there on the listed companies, which is because the purview of FRRB is restricted to listed entities. Financial statements are selected and then they are reviewed, and based on the review and the 4-tier mechanism that we discussed, the matters are then decided if they need reference to the director discipline, or whether they need to be sent an advisory, or they can be filed with the FRRB. Very important for all of you to know, because if you are signatories or preparers to financial statements which have public interest, which are listed, yes, at some point your companies might be selected at the FRRB and a very detailed, thorough review is done. And the reason why our institute does this at the FRRB level is A, to ensure the quality of its membership, and B, very importantly, is also to bring to your notice what are the errors and mistakes happening. It is not a board just to find errors and to punish our members. In fact, it is a strong belief of all the board members that we must educate our membership if there are common errors that are happening, if there are mistakes that are happening, to bring them to the attention of members. And with that intent only, the publications and seminars and sessions like this are conducted. So today, Khushroo Bhai will take you through all the non-compliances that we have received or noticed in the Ind-AS framework. That is one of the first sessions being held in the country. We had a national webinar, and now this is the 2nd seminar that we are doing on that topic. And after that, on the 3rd session, we will be discussing non-compliances that are noticed in the Schedule 3, CARO and other parts of the Companies Act, where again the role of the auditor is important, where they are reporting on issues, or where they're disclosing certain facts in the manner required in Schedule 2 or 3 of the Companies Act, and whether those compliances have been made. So in today's session, if you are attending for all the 6 hours, I'm sure if you're working in the Ind-AS framework, which is the IFRS converged framework, after the end of the sessions, you will be in a very good position to understand what the expectation of these standards is. Where is it that you and me as members, as auditors or as preparers of financial statements are making errors? And I'm confident that going forward, these errors will be avoided and membership at large will be hugely benefited by this session. With that background, with the role of FRRB, let me then begin with this 2-hour session that I have dedicated, because you will be going through the financial statements later. But what is a very common area for all of us in practice are certificates, projections, provisional statements, and the auditing standards, which also are looked at by the FRRB, and where is it that errors are being made. So let me first, before I begin deliberating on the topic proper, ask a very common question here to all of you. And again, you can answer it on the chat mode or whatever is available in this, or if not, ask and answer yourself. I put up a presentation screen in front of you, and you will see all these publications that are there. In fact, today even WRC released a publication on technology, and many members are not aware of what is the statutory position with regards to these publications. For example, the WRC publication which was issued today, well, it's only a guide. Nowhere is it mandatory. It's only as a reference material which will serve to members. But are all publications of the institute optional, or is there a different grade or a different categorization of publications? And the reason I put this up on your screen is because it's a very common error that we don't understand. If you look at the colors of the publication, it is not that I like green, somebody else likes pink, and somebody else likes another color, and that they have been put up here. It is in fact, each of these publications signifies certain level of importance. There is a authority attached to these publications, and therefore the color scheme is a particular one. If you look at the one in your center here, the compendium of standards, it can be accounting standards, it can be auditing pronouncement, that are all the engagement standards, it can be internal audit standards. These are all in fact in this color because they are mandatory in nature, they are standards. Yes, the internal audit standards date for mandatory implementation has not been notified, but they have been published as a mandatory standard, and therefore this pinkish red color. If you look at on the right, this is a dark green color, which is the guidance note, a very popular publication for all of you who are doing bank audits, a guidance note on bank audit. There is also a guidance note on tax audit, which is very popular. They have a dark green color. And what does that signify? Your standards, which are the pink color in the center, they are compulsory. So the statements and the standards of the ICAI, they are issued with the full authority of the council and are mandatory in nature for all members to be followed. And therefore, they have the highest level of categorization. Right below are the guidance note as per the authority attached to these statements. The guidance notes are dark green in color. Yes, they are recommendatory in nature, but the guidance notes authority flows from the council because they, like the standards, are approved by the council and therefore are as much mandatory, unless if you find that there is a deviation that you can take from the guidance note which is supported by a standard and you can justify it, only then you may deviate, or else for all practical purposes the guidance note what is mentioned there must be followed by the member in practice or the person implementing it. So standards compulsory, guidance note though recommendatory effectively are compulsory, and then there is the technical guide, the background material, the education material which you can see on the other sides. Well, these are all only to aid and assist members in discharging their responsibilities and functions. These are not mandatory in nature. So therefore, the reason I put this image here up in the beginning was that we can appreciate and understand that it is not that these colors are put at the whims and fancies of somebody who likes a particular color or not. They all have a very important statement. They all have a very important authority attached to them, and whether they are mandatory or not recommendatory, that depends on this. So I hope with this we have a clearer understanding of publications of the institute, and why it is very essential is because I very often see our members not understanding the importance of which document should they follow, whether it is a mandatory or not. Similarly, words such as audit, assurance, attestation are all very commonly intermingled and used, whereas each one of them has a very particular and precise meaning. And therefore, I thought it appropriate to begin this session, this full day session on by FRRB, with discussing with you the nuances of audit, assurance, attestations, all the engagement standards, that is audit, review, the quality standards, the assurance engagement standards, the related service standards, because they all have different meanings attached to that. And I feel, again, most of you will agree with me that whenever it comes to income tax, whenever it comes to GST, we are always keen and eager. If you look at a session on GST or income tax, thousands of people will participate, because somewhere the perception is that I can earn out of this, or I can give certain value add to my client, and therefore we have the hunger or thirst to attend these seminars. Sadly, audit assurance standards are not to earn, but they are perceived to be as to learn. And you don't feel that there is no value add to the client. Why should I do this? But I think that is where the largest pitfall lies. If it is not to earn or benefit your client, believe me, if we are not that aware of these standards, and we only do the audit the way we have been taught in our articleship period, to do the routine entries, cash, bank, journal verification, finalization, and close the accounts, without even thinking that in my life I will open the audit standards or the engagement standards. Believe me, it is not the right approach. If we can do it for income tax, we can do it for GST. Even for our standards, when we do with audit, I urge and request that we must look at the audit standards in the same perspective. I think it is with that intention that the council has made 2 hours of learning on audit standards this year, and 2 hours on the new code of ethics mandatory for all members in practice, so that we can develop this habit of understanding, reading, and referring to our audit and assurance standards. Because believe me, it is not that as council or as WIRC or as anybody else, we don't get participation, we don't get people to attend, हमें लोग नहीं मिलते, and therefore we said चलो compulsory कर दो so that people will attend. No, it is in fact, and I'm telling you this as chairman of FRRB, so many times when we look at audit reports, we see a clear cut issue on going concern. The profit is not there, there is an operating loss, there is an operating cash flow which is turned negative. There are no major assets that are left with the company. The net worth is turned negative. The director's report itself mentions that the future of the entity looks bleak, and yet auditors don't qualify or put a going concern note. Now, this is clear cut a deviation from our audit standards. And therefore, I mentioned that let's not only focus on income tax and GST where you can value add your client. Somewhere let's do something for ourselves also, because if such reports are maybe found by FRRB or any other agency, and in today's world when we are living, there is not just the ICAI, the PR review board, the QRB, the NFRA, but even in cases like was mentioned in the beginning by Arpit, that IBC is now in, and when the companies get referred, there is the NCLT which comes in, and in certain cases there is CBI, ED, everybody else which comes into the picture. And in those scenarios, when these investigative agencies look at our reports and you do not have your standards, then I'm sorry, your value add on income tax GST is okay. But if you're not able to protect yourself, then I think it's a very sad state which many members end up with. And with that intention, I hope that all of us, as we focus on the earning topics, we will also focus on these learning topics. And what better time than the pandemic for us to focus on this? Because the pandemic has taught us that it is these standards, the health and safety standards, wearing a mask with all of you at all time, keeping social distancing. These are all safety standards which help us protect ourselves from this deadly disease. So if we are able to follow health and safety standards for our physical health, why not look at the audit and assurance standards for our professional health? It is in fact like a kavach or a protection that is provided by these standards. And believe me, even in the disciplinary mechanism of maybe the institute or any other investigation, if you have proof that you have followed these audit standards, you are at a far, far better position and proposition than anybody else who has not followed this and then has to defend that he was not grossly negligent or did not collude with the management. And therefore, I hope that we all take this in that spirit. And I therefore now urge you that in this session that has been dedicated on not just certification, projections, and provisionals, we also try and improve our understanding and learning of these audit standards. And therefore, I think a very important definition that I try and put in the beginning is of assurance. And why assurance definition is important is because, like I mentioned, audit assurance attestations sometimes very commonly and intermingled used, but is a huge challenge for people to understand the difference. Because assurance, dear colleagues, if you can read on your screen, is a very clear meaning. It means it is an engagement where the practitioner, that means a chartered accountant in practice, expresses a conclusion, you have to conclude it, which is designed to enhance the degree of confidence of whom? Of the intended user who is other than the responsible party. So if it is, you are appointed by the management, but somebody else is going to rely on it, then it is assurance. Assurance will need an intended user other than the responsible party about the outcome. So therefore, assurance means you are going to assure a third party. And what better day for me to discuss the differences of nuances of audit, attestation, assurance, and accounting than today when we are sitting in Mumbai. And as was mentioned in the beginning, there is a study group which is working on the forensic accounting and investigation standards. To all my colleagues who are listening to this, we very commonly refer to forensic audit. Believe me, nowhere in the world does the forensic audit term exist. It is forensic accounting, and therefore even the standards that we are developing are on forensic accounting, not on forensic audit. And some of you may say, how can you call it accounting? We are not accounting for it. Why should it be forensic accounting? I think that is where the gap lies. Accounting is not bookkeeping. हम समझते हैं जब कोई हमें बोलता है अकाउंटेंट या अकाउंटिंग, हम उसको बुक कीपिंग से रिलेट करते हैं. Accounting is not bookkeeping. Accounting is a far wider definition. Yes, in India, sometimes when you call accounting, that is the first thing sadly that comes to our mind, to mind of regulators. But accounting is not bookkeeping. We are chartered accountants. Accountant is our second name or our last name. It is because accounting is a far wider definition. It includes audit, attestation, assurance, consulting, all of that put together is accounting. So therefore, when we talk about our firms, we are referred to as accounting firms, the large accounting firms, the mid-size accounting firms, chartered accountants. So please, to all of you who are practicing in this domain, let's try and understand and not loosely refer to the work as forensic audit, but it is actually forensic accounting. Because one, accounting is a wider domain. You are not just doing an audit, you are applying all other skills, analyzing, critically using all your skills and doing that report. Second, audit entails issuing an opinion. In a forensic, you are not giving an opinion that the accounts are true and fair. You are giving a summary of findings, and therefore again a reason for you not to use audit. And third and more important also is that audits, like statutory audits, have a separate scope, function, and how they are performed. The forensics is an art which goes a lot deeper, and our normal statutory audits do not go and audit at that level, and therefore it is very important for each one of us to distinguish and understand the difference between accounting, audit, attestation, and assurance. Let's not use it in a very loose sense. Like we in income tax would call receipt different and income different. All receipt is not income. Therefore, with the same concept, we must understand that it is accounting and forensic accounting. Audit is different, assurance is different. And once you understand this entire gamut, you will now be in a better position to understand the chart that I have put in front of you. Audit is this in the middle. Well, it's financial statements audit. I am doing audit under the Companies Act. I'm doing audit for the income tax, so it's a tax audit. I'm doing under the GST audit, so it's a GST audit. That's it. It is financial statements audit qua that act. The attest functions, well, that has additional points to it, because it may be, for example, attesting to management's assertions about internal control. So you attest it and certify it. They rely on it. There will be agreed upon procedures that you mentioned. So those are all attestation services. And what is assurance? Assurance is again, because risk advisory, performance review, all of that becomes a part of your assurance services. And therefore, you will see internal audit generally falls in the assurance service domain and not as an audit domain, because it's a larger perspective. And then there are compilation services. The reason it's a separate column here and separate circle here is because compilation is preparing of financial statements. Not very common in the Indian context, but yes, there is a specific standard, and we will discuss that when we talk about provisional standards of what is a compilation and when compilations can be issued. So I hope with the deliberations that we've had so far, we are all very clear and categorical about the difference between these three words of audit, attest, assurance, compilation, which is preparation, and the larger umbrella under which all of these fall is the accounting. Once you have understood the principle of assurance, then it is going to be very important for us to understand this flowchart that is there on the left of your screen. And believe me, if you can understand this, you will be very clear and precise. Any engagement that comes to you from tomorrow and a client requests, it may be certification, it may be attestation, it may be, for example, stock verification, it may be certain other specific agreed upon procedures that they want to do. You will be then able to apply the right set of standards for the right assignment. What are then the crux or the ethical principles or the base or the core of our membership? Well, we all are chartered accountants. The power to call ourselves that comes from the Chartered Accountants Act. The Code of Ethics, which was recently made amended and applicable from 1st of July of 2020, well, that is issued by the council, mandatory for all chartered accountants, either in practice or in industry. The Code of Ethics, there are separate clauses for all. That is a mandatory principle. And pronouncements that are issued by the ICAI and the council, for example, UDIN, other pronouncements which are all issued through the Gazette and notified. These all three, you can look at here, are put at the top of the chart because it is mandatory for all chartered accountants to follow. You may be in practice, you may be in industry, you may be in business, whatever you do, these three will always be there and applicable to us. That is where our power, our respect, and our standing in the society comes out of from. Below is the SQCs, a very important standard, sadly not very popularly used, and therefore we will spend some time today discussing it, but very important as a organization, as a firm. You may be a partnership or a proprietorship or whatever size of the entity. Standards on quality control are applicable, and therefore it's the overarching standards under the entire audit, engagement, attestation function, and therefore they're at the top. It covers all ambit of services. So SQC, there is one currently issued by ICAI, very important for all of us to follow, and we will discuss that. Below SQC, if you can see, the services can largely be categorized under two parts. Assurance services, and we go back to the definition. Assurance means you are providing some assurance to a third party, and therefore the word assurance, you are assuring them. And then there can be related services where you are not providing any assurance, you are doing other services. Management has requested you to do certain procedures, you do it. Management has required you to prepare certain financials, certain reports in a format, you do it. Those are called related services. So if you look at from the top, the Act, Code of Ethics pronouncement for everybody. SQC is the overarching standards which is applicable to the firm, just one SQC so far issued. Your services that can be divided into assurance and related services. So if it is not assuring somebody, it is for the internal purpose, then the standards that are applicable are the related service standards known as SRS. Standards on related services. That is why the RS, the related services. So SQC at the top. If it is not assurance, it is a related service. The standards are SRS. We will discuss these standards also. But if it is assurance, that means you are assuring somebody on the financial statements or otherwise, you can fall into two categories. You can provide assurance on historical information. That is, today, for example, we are sitting on 20th of December. You can assure and provide reports for 30th March 20, 30th June, quarter ended 30th September. Those are all historical financial, and therefore they are separate. But if the assurance is for example, let's say a future information, which is not historical, or for certain controls or processes, then the standards applicable are assurance engagements. Because remember, if it is not assurance, it is related service, SRS. If it is assurance service, then for assurance services, what will happen is, if it is not related to historical, you will follow the standards on assurance engagements, SAEs as they are referred to as. So the first set of standards, SQC at the top, overarching umbrella, all services covered. If not assuring somebody internal to the management, then related services, it is SRS. If it is assurance but not in relation to some historical information, SAE for the future, if you're, for example, certifying. And the topic today deals with forecasts, and therefore we'll discuss them. But if it is historical financial, that is to say 31st of March 20, 30th September 20, or 30th of 30th of June 2020, those are all historical. If it's an audit that you are issuing under the Companies Act or any other audit report, then the standards mandatory are SA, standards in auditing. But if it is a review, 30th June you did a limited review for a company, for a listed entity, then the standards applicable are SRE. So 5 set of standards which are very critical and important for us to understand. The SQC1 at the top, which is the overarching umbrella. If it is not assurance service, it is a related service, then SRS. If it is an assurance service but not historical, SAEs. If it is historical, it can be audit, then it is SA. It can be review, it is SRE. So these 5 set of standards that I'm discussing today with you. Therefore, I thought very important that we structure this program to deal with the audit standards in the first part, the Ind-AS in the second part, and then the Companies Act and CARO and the Schedule 2 and 3 non-compliances in the third part. So that for a corporate, all audits or preparation, all the important standards can be covered in these 3 sessions that we are going to have today. So therefore, let's once again understand the standards. Now very clearly you can see on your right all the 5 standards. I've listed them. The overarching standard is the SQC1. Below that, if it's historical audits, then SA, historical review, SRE. If it is non-historical, that is to say, for example, we're certifying some future forecasts or doing some controls or other parts, SAE. If it is not assurance and it is a related service, agreed upon procedures, compilations like we discussed of preparation, those are all SRS. So I hope with this we have been able to understand with certain clarity why these 5 engagement standards exist. We've also understood the authority attached to our institute documents, the highest ones being the standards, and then the guidance notes, and then all the publications which are not issued by the council. They're issued by the committees and are only to aid, assist, help and guide our members, whereas standards are absolutely mandatory. Guidance notes, though recommendatory, in effect are to be followed by members compulsorily. And the 5 set of standards in the engagement gambit. The question is, what is then the difference between audit, review, agreed upon procedures, compilations? Well, if you look at the chart on the right, which is in the form of a triangle, that will effectively clarify what is the different level of services that a chartered accountant can offer. At the top are audits, highest level of assurance. Let's be clear, it is never absolute assurance. It is high level of assurance. You are giving a reasonable assurance, but it is not absolute, but it is the highest level that a chartered accountant can give. Next are reviews. Well, reviews are limited assurance. So it is not an absolute or high assurance. It is a positive but limited assurance that is offered in terms of the financial statements. And therefore, if you look at the language of audit reports, it will always say, in our opinion, the financial statements are true and fair. So that is the language that is used. Whereas if you look at the review statements, the review reports, in the review you never issue a report saying true and fair, because you will only give a limited assurance, and your wording generally is that we have not become aware or nothing has come to our attention. That is to say, it is a negative assurance that humko kuch fraud, nothing negative was found. So these two are the separate levels of assurance. If you look at that chart that we discussed, in assurance engagements, in historical, you can do an audit or a review. Audit is a high level, review is a lower level, limited level of assurance that is provided. And that is the difference. Well, in the compilations and agreed upon procedures, there are no assurances that are offered. The audit standards, that is the SA, give you high assurance. The review give you moderate assurance. Your related service standards, that is agreed upon procedures and compilations, provide no assurance. And therefore, very important point that I would like to discuss at this juncture, which a lot of common membership asks me, is somebody has come to me and asked that please issue a provisional financials or unaudited financial. and I have put up the RAN's annual report here only with the purpose that it is one of the most commonly seen annual reports, and a lot of people refer to it, and therefore I thought it would be a good reference point. People say that I want to issue a unaudited financials, and the question is, if I am a chartered accountant and an auditor of the entity, and I'm signing in a testing without issuing a report, how is it unaudited? Can you simply sign financials, or do you have to sign and attest on that audit report? The question is, if you look at the international practice, barely will you see chartered accountants or the practitioners signing on the financials. But yes, it's a healthy practice that we do here in India. We sign the financials. But always remember, we don't attest the financials. We sign and attest the audit report. And therefore, if you look at any annual report that chartered accountants issue, we will always on below the financials mention the word as per our report of even date. And why is that? Because you are not signing the financials. You are signing it only for the purpose of ensuring that the numbers are as was finalized by you. You do not take any ownership of the financial statements. As auditors, you are signing on the balance sheet, P&L, cash flow, and notes to accounts pages only in reference to your audit report. Because it may be that the entire balance sheet is wrong and you have given an adverse opinion or a disclaimer of opinion. You will still sign the financials and say, Mera jo view hai, what is my view on these financials? For that, please refer to my audit report, because that is where I speak as an auditor. In the financials, I cannot talk. The notes to accounts are of that of the management and not of the auditor. And therefore, always the word that is referred to is as per our report of even date. And then below that, our chartered accountants sign. You sign as your member, your membership number, your firm name, firm registration number, you date it, and with the UDIN, we issue these reports. Very important point to understand, because a lot of times we confuse ourselves and state, you bring me that tally balance sheet P&L and I will write on top unaudited, sign, stamp and give it to you. No sir, you cannot simply sign and stamp the financials. That means effectively, what is the difference between you signing and the board of directors signing? Are you taking ownership of that financials? I'm sure you do not intend to do that. Therefore, don't simply take a balance sheet P&L, sign and stamp and issue it, and simply titling it as unaudited will not absolve us of our responsibility. In my view, what you must do is very clearly state that this is as per our report of even date, and then issue a report with that. If it's an audit, issue an audit report. If it's a compilation, that means you are issuing a provisional, which is you are not auditing it, you are only giving it for a certain banking purpose. You have prepared the financials as per Schedule 3 requirement, for example. It may be a non-corporate entity, but they want it in the format. You prepared the financials, you signed the compilation report, then you mention as per our report of even date, attach the compilation report, and then issue the financial statements. Simply signing on the financial statements and issuing them as such, I do not think it is the appropriate thing to do for chartered accountants in practice as auditors. Therefore, I wanted to discuss this point at this juncture, that yes, we are signing the financials, but we are signing them as per our report. Whatever we have to say as per an auditor will always be in the audit report. And I hope with this, I've been able to clearly lay out what is the expectations. We will then be answering all your questions regarding that. We have WRC have also received whether a chartered accountant, for example, can sign a provisional financial statements. Audit is not done, but can I do a provisional for banking purposes? I will answer that. Whether you can sign a projected future financial statement, we will also discuss that. What are the formats of certificates? Very important for us to understand. We will probably, if time permits, go through that guidance note on certificates also. So the first and most critical standards which is applicable to all firms, which I would like to discuss today, is that on SQC1, the quality control for firms that perform audits. And now we've looked at SQC1, which is the overarching standard. Below that, now we will understand the importance of this title, that perform audits. What is audits? Assurance in historical. If you're doing audits, then SAs. Reviews of historical financial information, that is you are issuing report as per SRE, and other assurance engagements, that is SAEs, and related service engagements, that is the SRS. So all your historical audits, historical reviews, projections, and other assurances, SAEs, your related services, SRS, all are covered under the SQC umbrella. And what does SQC talk about? Well, the SQC, there is one SQC which is issued by the ICAI. It deals with the standard on quality control, and the elements of this SQC are leadership responsibilities within the organization. Who has the leadership responsibility for quality? It deals with the ethical requirements for all your assignments, engagements. It deals with acceptance and continuance of client relationships. What are the norms for accepting, that is for the first time if a client comes to you, whether you should accept a client or not, and continuing, that is on an annual basis, should you continue with that client? You know that client has maybe done something wrong, is involved in a fraud, then whether you want to still continue with him as an auditor, that requirement is in the acceptance and continuance part. The human resource requirement, engagement performance, how do you monitor it, and the monitoring requirement. So this is the SQC1. The objective is very clear: to form a system of quality control intended for providing reasonable assurance that a firm is expected to answer. The SQC firm's system of quality control shall include policies and procedures addressing each of the elements which are mentioned in this diagram here. And therefore, very important for us to understand that this is applicable to all firms. And firms here include proprietors. So a firm is not just defined as a partnership firm, but even for proprietary entities, the SQC1 is mandatory to be applied and compulsory. So what is the first element then in the SQCs? The first element deals with the leadership responsibility for quality within the firm. This SQC1 deals with the first aspect, that it is the partner, the managing partner, the owner who has the responsibility of leadership of quality. You as the owner or proprietor or partner or managing partner have to ensure that any product that is delivered from your office has certain quality benchmark. It is not possible for you, for example, that when you are the leadership and you mention that, well, I have a firm in the office, my digital signature is lying in the table, so some staff must have gone. Institute is allowed with effect from 1st April to issue audit reports with DSC. So he opened my Word file, made a PDF, attached my DSC, and UDIN password, it goes in email. One, I receive an SMS, so he must have taken the UDIN from email, attached UDIN, attached my DSC, and issued this certificate. And I do not know how this happened. Well, sorry, this cannot be a grounds for you to state that this was done because this is how my office functions, this is how my digital signature is lying loose, my UDIN password or the OTP comes to everybody in the office. It is not acceptable. Your leadership responsibility. If you do it for convenience, somebody else is doing it, fine, but then the buck stops with you. It is the owner, the proprietor, or the managing partner who is responsible for ensuring the quality within the firm. The SQC1 very clearly casts responsibility of leadership within the firm, and therefore ultimate responsibility of design. So how must the quality be operated? Its implementation, its operating effectiveness, and its design is the responsibility of the leadership. Any report which goes out from your entity, balance sheet, assets total is different, liabilities total is different. No, you must have quality control process that once somebody has audited, finalized, somebody else reviews it. There is another review level that is formed within the organization, and that reviewer very clearly sees and notices these errors, because that having that quality control mechanism is the responsibility. And if somebody in the firm, for example, doesn't adhere to these, then there must be disciplinary action mechanism within the organization that must follow to ensure that these people who do not follow the firm's quality control are punished. Your commercial considerations cannot override quality control. You cannot state tomorrow that 5,000 rupees ka hi fee tha, so for 7,000, 5,000 rupees, this is all I can do. No, a commercial consideration of fees can never override the quality requirement that is expected out of chartered accountants through the SQC1. You will have to ensure that you evaluate client relationships and your fee considerations and scope of services cannot infringe upon your quality of work. You must have within the organization a performance evaluation and compensation policy. Each staff must have the opportunity to advance. The leadership must deploy sufficient and appropriate resources for developing these quality control mechanisms. That is the example that I gave you in the beginning also, that when you are the partner, you cannot simply state that no, somebody must have misused the DCSC and you didn't done this. It is the responsibility of the partner of the firm to ensure that yes, the managing partner or the proprietor, that quality in all the products, all reports, certificates, annual reports, balance sheets, audit reports, whatever come out of my entity, they maintain this level of quality. So the first element of SQC1 is quality and leadership's responsibility for quality. The second, well, it deals with the ethical requirements. Some very common overlap here with the code of ethics, but extremely important that when you are doing audit assurance engagements, you have to be objective. That is why, for example, in the Companies Act, you cannot be a shareholder for the audit client that you are going to audit because you will lose the objectivity. A surgeon will generally not operate on his own son because his hands may tremble. Similarly, if you're a shareholder, you have interest in the share price of the company, and you may not be objective, and therefore there is a debar on shareholders doing the audit of entities. You have to be objective and independent. Your integrity has to be world class, and I'm proud that yes, as chartered accountants, we have the highest level of integrity in all the functions that we perform. Confidentiality. You have clients' confidential information. What are their newer plans? What is their raw material cost? What is their BOQ? Who are their vendors? You have access to all the confidential information of the client. And yet, yes, as chartered accountants, we are maintaining highest level of confidentiality. Even in pharma companies, for example, the crux is, what are the raw materials, how it is mixed, the entire process. Our chartered accountants and employment or as auditors are aware of these facts, but yet are able to maintain confidentiality, which is the cornerstone of our profession. Professional competence, we must be able to have the competence, have enough qualified people in our team who are able to do this. I shared the annual report of Reliance. It is not possible that one C and two articles and do the entire audit of the entity. You will need professionally competent people who understand industry nuances and are then able to deploy them to ensure the quality of audit. You have to be due diligent, and most importantly, you need professional behavior, professional conduct in every way you deal with your clients, in the way you talk, in the way your office is. If your office is there are thousands of papers, files lying there. You don't inspire confidence or professionalism. So I think, in my personal view, professional behavior is not just how you conduct yourself, but it is everything from how you dress, address, how your office is. Everything matters in terms of your professional behavior. And therefore, the ethical requirements are extremely important. The independence and ethics partner must be designated in the organization who ensures that every person who's the partner of the organization, or for example, who's in the audit engagement, is independent of the audit and he's able to independently look at it. He has to ensure that the code of ethics is also followed within the organization. There must be a procedure to communicate independence requirement within the firm's personnel. So here I've given a simple example. For example, if there is an audit client you have which is a listed entity, it's always advisable that you take from all members of the firm a annual independence confirmation, which will allow you to understand and appreciate whether your organization's ability to independently and objectively audit the entity is not lost. You have to identify and evaluate possible threats, and if you're not able to reduce those threats and bring them to an acceptable level, you will have to withdraw from the engagement. The policy for this can be to obtain a written confirmation within the firm for independence and ethics confirmation, and confirm that each of the staff adhere to this independence confirmation. I've given here a sample annual firm personnel independence confirmation, which you can take from all the employees, partners, and everybody within the organization to ensure that yes, my entire firm and its personnel are independent of the entity in which we are issuing an audit opinion on. A sample form has been attached where the representation from every employee or every staff can be taken and sought, so that independence is not just ensured by policies, but even written representation is available with the organization to prove its independence. The third element of SQC1, well, it is acceptance and continuance of client relationship. Every year you must decide whether you want to continue with the client. For example, if you have a client which is now has done a huge amount of fraud, it's a high risk assessment entity because of various other investigative agencies looking at it, whether you want to continue with it. And if you are continuing with, then of course you will have to assess the risk at a higher level. That must ideally be documented. What are the factors that you consider whether before accepting a client? For example, somebody every year is changing his auditors. That's a risk that you can immediately see. Then whether you as an auditor want to accept that firm who has changed an auditor every year. And if you're accepting it, then please have a clear acceptance policy documented for it. I've given here an illustration, an illustrative client engagement acceptance form, which all organizations can use. Again, this is more of an internal requirement and process, but I recommend that we have such an illustrative list for engagement acceptance and continuance, where there are basic questions regarding whether the entity should be accepted or not, and a yes no answer, and based on that, at the final, the partner who's accepting the audit can sign and say why the client must either be accepted if it's a new client, or annually the continuation must happen. The fourth important element of SQC1 deals with human resource. You must have sufficient human resource to take up the volume of the work, the client. You must have trained personnel to ensure that they are able to do the task on hand effectively, and they have the requisite amount of skills that is being able to complete the assignment with the quality that is expected out of them. And that is an important element of SQC1. Then engagement performance. You must have an engagement performance policy within your organization. How the assignment is going to be performed, what are going to be the procedures, whether the objectives of the assignment are you are able to effectively communicate. These are all questions that you must have within your engagement team. And if there are differences of opinions, how will you resolve them? For example, the engagement partner, that is a person signing the audit, and the reviewer have a difference. How do you resolve that within the organization? All of those must be taken care, and within the engagement performance must be monitored. And therefore, a very important part of the SQC that we will have to follow, and engagement has to be documented and ensured. Well, element 6, the final element of SQC1 deals with monitoring, that you have to constantly develop the SQCs, ensure that all these policies are effectively communicated, circulated to all your employees, and they are on a regular basis monitored. The final two pieces of the SQC1, and I have mentioned the link where you can find SQC1 on the institute website here. The SQC1 talks about documentation, how you must document it. Larger firms, for example, may use electronic database to document matters which are related to quality, which are related to other aspects, and you can put all your other audit related documents there. The SQC1 talks about how you may have electronic form of documentation. Smaller firms can use the audit files. What are the factors that determine the form and content of documentation? Well, it's the size of the firm. Based on that, your documentation level depends, and the nature and complexity of the practice. And what is the retention period? Well, if you look at the para 83 of SQC1, many people ask me how many years should I retain the documents of an audit file? Well, earlier, there are seniors attending would realize the erstwhile auditing and assurance standards, the ICAI, had 10-year requirement. Well, after the introduction of SQC1 and specific mention of para 83, it states that for audit engagements, the retention period is ordinarily no shorter than 7 years from the date of the audit report. So, for example, a 2013 audit, if it was done by you in, let's say, September 2013, September 20, then yes, you can do away with March 13 audit files because they are more than 7 years old. But for 7 years at least, you are supposed to maintain your documentation of your audits. The SQC1 is where you will find this. So I hope with this we have been able to effectively discuss all the publications and the authority attached to all the statements and publications of ICAI. We could appreciate the different standards that are there within the firm, which are applicable. The SQC1 we have discussed right now, which is the overarching standard which covers audits, reviews, assurance engagements, and related services. And the importance of signing the financial statements, but at the same time signing it as per our report of even date, because you are not attesting the financials as a preparer, but you are issuing it along with your audit report. So there, with that, we come to the topic of standards on auditing. SQC1 at the top applies to all your assignments. If you are providing assurance engagements for historical financial information, that is to say 31st March 20 year ended, and it is an audit report, then the standards which will be applicable to you are standards on auditing. A company audit, a tax audit, these are all audits which are done on a historical financial information, and therefore the standards on auditing applicable will be SAs. I think a lot of sessions would have happened in WIRC on these topics, so I will not dwell too much onto this. We will just browse through all the requirements of these standards. The SA 200 to 299 series, again, if you look at these standards, these are exactly in line with the international audit standards, that is ISAs issued by IAASB. India has adopted this. There was a clarity project that IAASB took up, through which the numbering of these standards has been done in a manner that is very easy for one to understand. The 200 to 299 series, to start with, deals with the general principles. The 200, the first audit standard, well, the overall objectivity of the independent auditor, that is dealt with in SA 200. A very important standard that I would like to touch upon is the SA 210, agreeing the terms of audit engagement. And here I cannot emphasize enough the importance of this standard, the importance of having an engagement letter with you for any assignment that your firm or you as a proprietor take up. Please, with folded hands, I request you, always have an engagement letter. It is not that just the appointment letter is received and you start commencing your work. So many times one would have seen that, for example, if the management is caught with something and they are facing certain criminal investigation, and somebody asks them, why did you do this? It is such a sad state. They simply state, oh, that my CA was looking after everything, he would have done this. My auditor did everything. And then immediately the police or the criminal investigation can come to you. Well, why will he say that? Because he wants to get it off his shoulder. But if you do not have an audit engagement letter which clearly states, and please remember, in the audit report we state that the financial statements are the responsibility of the management, but you are only signing the audit report. So you have made a statement there. But I, in my opinion, feel that even in the engagement letter, which is signed by both you and your client, audit report is not signed by the client. In the engagement letter, it is critical that we mention that the responsibilities of the management are clearly highlighted. That is to say, the responsibility of preparing financial statement is of the management. The responsibility of having the design, implementation, and operating effectiveness of internal controls is of the management. And our responsibility is only to give and express an opinion on these financials. So that entire fact, co-signed by you and your client, is what forms part of the engagement letter. It also states, for example, that though my SQCs require me to be confidential, if tomorrow there is a peer review in my entity, I will share my working papers and this information with my peer reviewer. And here again, because the engagement letter is countersigned by your client, you have effectively taken their consent that this information will be shared by them. So tomorrow he cannot say that you have not followed confidentiality. Your fees, so many times one sees disputes between the auditors and the clients. Those fees of what you will charge for the engagement, that has to be a part of your engagement letter. And one also sees in other engagement letters a very clear statement that for any negligence which may have happened during the performance of the functions, the financial liability of the chartered accountant shall be restricted to the fees received. Again, an important clause that can be included in your engagement letters. So sample engagement letters for tax audits, for companies audits are available on the Institute's portal. I would request you that for all your audits, and not only audits, as we go forward in the other standards, you will see wherever there is talk of engagement letters, they will refer to the SA 210. Therefore, a very important and critical standard that we must all understand and appreciate. Therefore, I wanted to highlight. You may have had sessions on standards on auditing by WRC in the past, but I believe a very important session that standard that one must have, not just for audits or reviews, but for all services that one has, have an effective engagement letter. The 220 talks about the quality control in an audit. 230 talks about documentation, how the documentation must be. It must effectively be such that a third party can come and looking at the documentation itself can judge what you have done, whether you've done your assignment in the right manner, in the expected manner, and as per the standards. The 240 deals with the auditor's responsibility relating to fraud. We are all aware we are not going into an audit unearthing a fraud, and therefore I go back to what we discussed in the beginning. Forensic accounting is separate and statutory audit is different. That is not forensic audit, it is forensic accounting. It drills down, goes deeper. In audit, my responsibility is not to just go and unearth a fraud. I'm not going there with the intent or hypothesis in my mind that there is going to be a fraud. It is the responsibility of you. If you find a fraud, you will have to report it, no doubt. And yes, the expectation of regulators from us, from audits, is increasing. They expect us to be more vigilant in our audits, but again, this standard is there, which very clearly states and lays out the responsibility relating to fraud and the auditor's responsibility. If you are receiving a fraud, you are supposed to report it. Now, the Companies Act requires, for example, if the fraud is in excess of 1 crore, the MC has to be reported. But the standard deals with the responsibilities of the auditor for fraud. SA 250, another important standard, laws and regulations. So not just, for example, if it's a company audit, you discuss the compliances of the Companies Act, but if you notice certain material deviations and non-compliances of other laws and regulations, which have a material bearing on the financial statements, then you are not restricted, for example, in the tax audit only from clause 1 to 42. If other considerations of laws and regulations affect the materiality, then as per SA 250, you will have to consider them in your audit. 260 deals with communication with those charged with governance, which we refer to as management. 299 generally applicable in joint audits, larger audits, or government audits where there are more than one auditors. We move to the next set of standards, which is the 300 series and the 500 series. The 300 to 400 series is about risk assessment and response to assessed risks. Again, the new approach of audit, of how one must approach audits. It is a risk-based audit. Traditionally, audits were bottom to top approach. You would look at cash book, bank book, journals, ledgers, and then finalize the accounts. Well, the standards expectation is that you must have a top to bottom approach, also identify risk. So when you plan audit engagement in SA 300, you have to identify, first define what is the risk of materialities. What is your materiality threshold? You will have to define. That is your planning materiality and your performance materiality as per SA 230. Identify the risks, which are the accounts which in your view can be risky, and those have to be responded to by the auditor. Your audit procedures must be designed to have a risk-based audit. So no longer can you just go from bottom to top. It may be an approach that your firm follows, but you must also have the documentation to state how you have assessed. For example, there is a new account, there's a new business line. If you see there is a certain riskier account, then there must be specific procedures performed to identify and assess that risk, and then understand the entity and the environment of how it functions and your entire audit response to those assessed risks. That is dealt with in SA 300 to 499. The 500 series, well, this is the crux, the meat, the substance of the audit. 500 talks about audit evidence. Evidence, what can be the form of evidence, how you must go and collect it, what are the different forms of evidence that is available to you as an auditor. The 501 is in special considerations. 505 again, very important standard, external confirmations. It is the highest form of assurance for you as a auditor that you can get if your balance, for example, is confirmed by a third party externally. So the confirmation must directly come to you as an auditor. The client cannot go and get you a confirmation. But for example, let's say the bank balance as of 31st March, you want to confirm, you directly write a letter to the bank. The bank responds to you at your address and you receive the bank balance, and that agrees with the bank balance that was reported in the bank reconciliation statement. Well, that's a external confirmation, compliance of SA 505. Similarly, other balances except bank balances, that is debtors, creditors, can also be confirmed. The opening balances, again, for initial audit engagements, how would you tally and agree the opening balance testing? Analytical procedures, how you analytically look at accounts. For example, year-on-year comparison, quarter-on-quarter comparison, current quarter, previous quarter, current quarter, same quarter of the previous year. Certain expense items in a percentage correlation to sales. Those are all analytical procedures that can be performed easily on Excel sheets, and very important for you to analytically assess and do these procedures to identify why there are deviations. For example, if the production remains same and the electricity expense is also the same, and you can see that the rate of per unit charge is not changed, you are comfortable. You may not even want to do the vouching of all the invoices. But for example, you can see that the production has increased 2 times, the sales has increased 2 times, but electricity expense has gone down, and the rate of electricity is the same, there is no new subsidy, then it immediately must strike you that maybe the electric expense is not reflected correctly or is underreported. So those are all analytical procedures important in your audit. The other standards that deal with related parties, subsequent events, again, very important in this post-pandemic era of how you do the subsequent event testing, what the entity has done. For example, from 1st April to if you're signing the audit report today on 15th or 17th of December or 20th of December, what are the subsequent events which may have a material bearing on 31st of March. Going concern, very important standard, SA 570. As chairman of FRRB, and today let's not forget we are discussing from the FRRB perspective, a very, very common error. My request to all participants, if you are attesting, auditing financial statements, please refer to the standard. And you will know in what situations you are supposed to compulsorily qualify a report. The SA 570 very clearly gives you guidance that if going concern is hampered, doubt about the ability of the entity to continue as a going concern, SA 570 gives you enough guidance on how we must qualify the report. Simply stating it in notes to accounts, I'll very honest, it's as at the board we are seeing such cases where members are not complying with this standard and making a lot of errors and mistakes in compliance with going concern. That is why I would urge all members, please look at SA 570 in detail, follow it thoroughly, and then you will be able to discharge your responsibility as auditors and correctly, if you are required to qualify or draw attention to it, in what level you should do it is sufficiently covered in SA 570. 580 deals with written representation. Well, the 600 series is using the work of others. Primarily, it can be another auditor. For example, you are a group auditor and there are branch auditors. You are a central auditor, there are branch auditors. 600 deals with this. If you are the holding auditor, subsidiary auditor, that is also dealt with in 600. Using the work of internal auditors is what 610, how you can leverage their work. And 620 deals with using the work of an auditor's expert. For example, in construction, in real estate, you may be using the work of an architect or an engineer. Well, all of that is dealt with in SA 620. This 800 is for specialized areas, so I will not dwell with it. But a very, very important set of standards, and the final set in the SA series is the 700 series. And once again, I would urge as chairman of FRRB, very critical, very important for one to note that these standards are the ones that you must refer to every year. I urge all participants, make it a practice that when you issue a report in the current year, always go to the institute's website and get a copy of the SA 700 report and ensure that your financials are, for the first time when you're issuing the report, in compliance with the 700. There are illustrations at the end which very clearly update and tell you where the audit report, in what format you must issue. You'll be surprised that even now, after the format has changed for almost 3 years now, that opinion paragraph is the beginning, some auditors are still issuing it in the old format. I think if you have to improve the quality of our services, if you have to improve the stakeholder perception, I believe our compliance of these standards and our, if I can implore you to stop using the formats. I think it is this formats which is related, caused us to make these errors. So many times one sees that you are carry forwarding previous year's format, and the format of audit report has changed, the illustration of the SS700 has changed. Please don't use these formats. I always say this, it is the art. Audit is not just in science but also in art. If you are not able to update yourself, if you're not able to look at the standard and simply copying the formats, think of it if any other profession was to do it. If the medical profession was to always rely on format, today you are looking in the US, UK, people are receiving vaccines. If scientists would rely on formats, not innovate, not get updated, they would never be able to find a cure to this disease. If architects rely on format, well, you will see the same building in India, in Mumbai, in Ahmedabad, in Surat, in Pune, in Delhi, all buildings will be same. No, as professionals, we are not here to follow formats. We have certain set of standards, and those standards give us the correct way of presenting an audit report. The SS700 gives us the correct illustration of how the report should be. I would urge you that please follow that in the SS700. The 701 was made compulsory for listed companies last year. Talks about CAM, key audit matters, a very important standard which empowers the auditors. That there are certain matters which are not qualified, which do not result in adverse or disclaimer of opinion, which do not require in the modification of opinion, as I said, or require an EOM paragraph or other matters paragraph. But you still think it's important material that you can mention it there as a key audit matter, what you discussed with the management and how you resolved it. It's actually an empowering tool which is available to you, and I would urge that if in any listed entity you have not come across these scams, please ensure that you stay updated. This was implemented last year. This is the second year in which scams are going to be reported for March 20. 705 talks about the modifications in audit report. The modifications can be in the form of a qualified opinion, in the form of an adverse opinion, in the form of a disclaimer of opinion. In what stage, if it's a pervasive, if it's a material non-compliance, what should be the modification? That is what the 705 deals with. And the 706 deals with the EOM, that is the emphasis of matter, where we draw attention to it. Again, sometimes at the board we see financial statements that the auditor was in fact qualifying, but he used language of we draw attention to. Please don't mix and match standards. There is a very clear-cut guidance of when to qualify, when to have an adverse opinion, when to have a disclaimer, when to have an emphasis of matter provision, that is to draw attention to a fact, whether when to have an other matter paragraph. And these are all dealt with in the 700 series, which is extremely critical for all of us to follow. So with this, we have understood the SQCs, which is the overarching standard, the SAs, the crux, the auditing standards when you're doing with assurance service for historical financial statements, and it's an annual audit, then audit standards. But if it is again historical assurance service, but you are not providing the highest level of assurance that the audit provides, but you are providing limited assurance, well then you use your SREs. Two standards, 2400 and 2410. I will take 2410 first. It is very common for all the auditors who are practicing in listed entities. We are issuing the limited review reports. The limited review report is issued under the SRE 2410. And what is the difference between these two standards? Well, very simple. 2400 is engagements to review historical financial statements. So if it is a full year of financial statement, you will go to 2400. If it is an interim financial statement, interim meaning 3 months, 6 months, 9 months, then 2410. Therefore, I took up 2410 first because for SEBI clients, we are issuing our report as per SRE 2410. And if you are reviewing interim financial statements, we are issuing unaudited financial statements, but we are issuing a review report with that. Well, quarterly or half yearly basis, those reports are as per the SRE 2410. Then what is 2400? Well, there may be certain entities, for example, who are not subject to audit. If it's a company under Companies Act, obviously you will do an audit, but maybe a non-corporate entity, but still wants, for example, the bank states can know, I want an auditor to give me a good level of assurance on this. Then you can take up the assignment as a reviewer. Again, very important note, if it's statutory audit is going to be done, then you cannot be the reviewer because you are giving a high level of assurance. Then no meaning giving a limited assurance and a high level of assurance. Therefore, statutory auditor cannot give this. But other than the statutory auditor, if you want to get a limited review done for your entire year, that limited review of that entire year can be issued as per SRE 2400. Only important point, like I mentioned, statutory auditor will have to give an audit report as per SA 700, so he cannot issue a report under SRE 2400. But if the company requires somebody else to review it and issue for their own purposes for some other banking purpose, other than the statutory auditor can issue it. And in the case of non-corporate, where you're not doing a statutory audit, you can always issue SRE 2400 for the full year. The 2410, well, it is for interim financial information. The purpose of this is to give guidance of how you can review interim financial information. You are expressing the conclusion based on the applicable reporting framework. So it may be Ind-AS or it may be the accounting standards. The procedures involved in the SRE, it is not an audit, it's a review, and therefore are more in the form of inquiries and analytical and review procedures. You are not doing so much test of details, and it is interim financial statements. Interim is defined as for a period which is shorter than the entity's financial year. So if it is April 1 to 31st March, but I'm doing a financial reporting and a review report for April 1 to 30th June, then I will call it an interim period and use SRE 2410. If it is for the full year, then it is SRE 2400. And like I mentioned, that cannot be by the statutory auditor. When we discussed the standards on auditing, I had drawn attention to your fact that all standards will deal with SA 210, that is the engagement standards. The audit standards related to engagement letter and the acceptance of an engagement. Here again, reference is drawn to the SA 210, and you must have an engagement letter for this similar to that of SA 210. Well, the procedures that you must perform for a review of interim financial statements, we discussed. These are inquiries, analytical procedures, and what you must perform is given in this presentation. I will share it with the region, and you can have a look at the procedures that are mentioned here. We've discussed this when we were dealing with the analytical procedures also. The SRE 2400's documentation must be such that it is sufficient and appropriate to provide a basis of how you have come to the conclusion that you have issued the opinion, and you must document all of that. The documentation standard is clear. Your report is a moderate level of assurance, and the verbiage or the language in this report is that it says nothing has come to our attention. You have to communicate with the management if there are substantial adjustments are required, or you believe there is non-compliance or fraud. So this, by and large, is what SRE 2410 deals with. With this, we have completed and concluded on the assurance engagements dealing with historical financial statements. SQC1 was the overarching standards applicable to all. If you are providing assurance services and on historical information, two standards that we deal with. One was for audits, SAs. The second set of standards, if you're dealing with reviews, then SREs. Now we come to assurance engagements that are not in relation to historical financial information. That is to say, for example, you are dealing with prospective financial information, or for example, you are dealing with controls at a service level organization, or you are dealing with engagements for compilation of pro forma financials. Many a times you would have seen when companies get listed, the prospectus is to be issued. In the prospectus, there are 5-year projections that are incorporated. That is not historical financial information. Therefore, we do not issue an audit report or a review report, but the assignment is conducted as per SAEs. So we will now deal with the standards on assurance engagements. The first and foremost and the very common one is SAE 3400, the examination of prospective financial information. I go back to the title of our today's discussion, which deals with certifications, projections and provisionals. So projected financials or prospective financial statements. Let us be very clear. As per clause 3, part 1 of the second schedule of the Chartered Accountants Act 1949, a member in practice will be deemed to be guilty of professional misconduct if he engages in estimation of earnings contingent upon future transactions in a manner which may lead to the belief that he vouches for the accuracy of the forecast. What does that mean? That if you as a chartered accountant are certifying certain future financial information in a manner that the user is drawn to believe that this will occur, that yes, March 21 financials turnover will be 105 crores, March 22 will be 125 crores, March 23 will be 300 crores. You sign, seal and deliver without a report, and that leads to somebody in believing that you have vouched for the accuracy of certain future information. Well, you are guilty of professional misconduct, because till date our final course curriculum does not have astronomy or astrology. We are not here to predict what will happen in the future. So please be very careful, and for bank's pressure or some client's pressure who ask you to sign CMA data or any future projection data, we cannot issue blanket projection and just stamp and sign it. That will be clear cut a violation of clause 3 of part 1 of the second schedule of the Chartered Accountants Act. Then the question arises, what can be issued? Well, what can be issued is a report under SAE 3400, that is examination of prospective financial information. Here the language of this standard of the report is very clear, that you will never vouch for the happenstance, that is these things will occur in the future. You are not vouching for. What you are certifying or attesting to or providing assurance on is only the fact that you have tested the assumptions, you have looked at the calculations, and the assumptions are reasonable in your view and the calculations are all right. But as a chartered accountant practice, you are not allowed to simply sign it. So SAE 3400 talks about prospective financial information. 3402 is for controls at service organization. If you have audit of a KPO and if you have to report to some head office, to some foreign entity, you should use this standard. The 3420 deals with the pro forma for prospectus. So let's get back to the title of today's discussion: projected financials, prospective financials. Well, for prospective financial statements, the SAE 3400 clearly provides the purpose to provide guidance on engagements to examine reports on prospective financial information. You are providing a report on financial information. You cannot simply take an Excel sheet with 5-year projections, signed, stamped and sealed and delivered. Like I said, it is not our job, it is not our mandate to simply sign, seal and give a unaudited financial statements without issuing a report thereon. Similarly, for these financials, what is allowed is to issue a report on them. And how can you report? Well, you have to first understand what is the meaning of a prospective financial information. It means financial information based on assumptions about events that may occur in the future and the possible actions by an entity. You will have to accept the engagement, the steps involved in SAE 3400. So be very clear in the engagement acceptance that you have to consider who is the intended user, whether the bank is going to use it. Be very clear if it is only for a limited purpose, then mention it in your report, that is distribution. For example, the company takes that projection and prospective financial information for you and shares it to the world. That must not be intent. The distribution should be limited to only those that you have prepared this for, and the nature of assumption and the period covered must be clearly mentioned. You must look at the operating cycle, the degree of reliability of assumptions. For example, if the company is stating that I am going to grow at 8% and the prospective financial information is prepared on that basis, you can understand that yes, what was the past historical data, and yes, the company has been growing for 2 decades at 8%, then it's a reasonable assurance to have. For example, if the entity is planning to launch a new product, then the period covered should be short and broken into smaller segments such as weeks and months. So that will have to be done for you to have a degree of reliability of assumptions, and the need of the user. You will have to be very clear. The knowledge of the business is very important. You must know the internal controls over these financial statements, the expertise of the person who's preparing the projections, how the mathematical and statistical techniques have been used to develop that prospective financial information. If any other information was given, for example, 5 years ago also, they gave you a prospective financial information. You can compare that with actuals and test the assumptions. And once you have done that, your examination process is complete. Ensure you have sufficient and appropriate audit evidence in the form of the estimates, how they have taken the assumptions, and test the assumptions. Your working papers should include the source of information, how did you extract the source of the base year and the future years, the basis of the forecast, the evidence, take a representation letter from the management. All of this should form part of your documentation. Having satisfied yourself, you can take a representation from the management and issue a report. The report can be a modified report if, for example, the disclosures regarding the assumptions is not appropriate, reasonable basis is not found for that, then you can modify a report, or you can give an unmodified report, but always follow the standard SAE 3400 for issuing this report. There is an illustration at the end of SAE 3400, and whenever you are issuing prospective or projected financials, like I mentioned, simply signing and stamping them and issuing them, well, definitely you will be in violation of the clause 3 part 1 of the second schedule of the Chartered Accountants Act, because it prohibits you to vouch for something which may lead others to believe that you are vouching for the accuracy of the forecast. But you can issue a report under SAE 3400. So with this, we have concluded the set of assurance engagements. We discussed SQC1, which is the overarching standard. For historical assurance, audits and reviews. If it is not historical, like in front of you, the prospective financial information, service level controls, or for prospectus, you are giving future information which is not historical, SAEs, and a very important standard, SAE 3400. And finally, if it is not audit, not review, and not also assurance, that is to say it is a related service, then two important standards that we must all be aware of is SRS 4400, which deals with engagements to perform AUP, that is agreed upon procedures, and 4410, which deals with compilation engagements. 4400, a very useful standard in your day-to-day practice. Lot of times clients come to you and tell you that we want, for example, a physical inventory verification report. They may want you to test certain facts. They may give you certain numbers and they want assurance on it that yes, can you check the claims that have been submitted? They're okay. And you're reporting to the management. These are all what we call as agreed upon procedures. And like I mentioned at the beginning, sadly, because of lack of knowledge of standards, lot of times we are actually giving this nature of service of agreed upon procedures, but because of want of understanding of this standard, we are not referring or titling our report as agreed upon procedures, but simply issuing as a certificate. So I would urge today through this platform, if your report is an AUP, you are performing agreed upon procedures, then kindly issue your report as per SRS 4400. A very good exhaustive illustration is given along with this standard, and whenever you are giving your report on such matters of agreed upon procedures, where management is required you to do certain procedures and report to them, you can use this format. And finally, SRS 4410, we discussed audit attestation assurance, and I mentioned compilation. Compilation is not an audit, not an assurance service. It is simply reporting or presenting financials. So for entities that are non-auditable, but you want to prepare a financial statement, there is no tax audit, but the entity says that please, can you do up financial statements for us? Well, you are not the auditor. Let's remember, because You are filing a tax return, so you're not providing any audit attest assurance service. But the entity, now the tax audit limits is increased, and the management still wants that you prepare a financial statements. What you can do in those cases is go to SRS 4410, use the report under the compilation standards, prepare the entire financial statements, and like we discussed, simply don't take the balance sheet and P&L and sign on it. It is always supposed to be as per our report of even date. Issue a compilation report for these non-auditable entities, and you can issue a compilation engagement as per SRS 4410. Again, needless to mention, if it's an audit client, then you cannot do the compilation services. But if you are, it's a non-auditable entity, there is no audit you are doing, but they want financials, banks require, other purposes they need, then you can use SRS 4410 and issue standards as per this, issue the report as per this standard, and use the illustrative guide. I've given the link to all of these standards at the bottom, which is available on the ICAI's website. With this, dear colleagues, we conclude on the engagement standards that was very important for me to deal with. We discussed on the statements and the authority attached to statements, to publications, what are standards, what are guidance notes. We discussed the difference between audit assessed assurance. We understood why you cannot simply sign the financials, and it is always in reference to the report that you are attaching to the financial statements. That report can be in the form of audit, it can be in the form of a review. If it is prospective financial informations, SAE, because it is non-historical. If it is not assurance, it can be compilation, that is SRS 4410. And with this, the entire gambit of engagement standards has been covered. The topic for the day was dealing with certification, projections, and provisionals. For projections, we have seen SAE 3400. For provisionals, we have used SRS 4410. Like I said, do not just simply mention audited and provisional and issue it. Use it along with the standard. And the final topic that we have to discuss is certification, and a very, very important guidance note which the institute has issued. Sadly, not very popular, and therefore I thought I must bring it to your attention. Certificates are not covered by FRRB, but I thought that when we are discussing the entire gambit of engagement standards, it's a very, very important piece of publication, a guidance note that deals with certificates, reports which are issued by chartered accountants. The guidance note, like I mentioned, is effectively mandatory for us, and I'm assuring you, instead of using the standard reporting that to whomsoever it may concern, it is hereby certified that based on information and explanation provided to me, or based on books of accounts verified by me, we hereby certify that. The old formats that were being used for certificates, please get over them. It's an excellent guidance note which deals with certificates. What are the procedures you must perform? If you look at the illustration at the back, it clearly gives you the paragraph which says that the certificate is as per the guidance note, so your risks is limited. It also deals with a paragraph specific to what your procedures are, so that somebody cannot put undue liability on you. For example, if you're giving a turnover certificate, you will mention that the turnover is verified from the financial statements. The entire verbiage is given there, the language to be used, how you have extracted from there. So you are not taking up responsibility of the financial statement, only stating that the turnover from that financial statements you have extracted and noted here. If he's using it for a tender, your client is applying this turnover certificate for a tender, it states that this certificate is only for certifying the turnover. Other conditions of tender, it is not the responsibility auditor. So tomorrow the CVC or the tender agency cannot come to you saying he was not qualified. Well, I was only looking at the turnover criteria. Most importantly, we discussed this earlier also, there is a para on limited use or restriction of use. That is to state that if you are issuing the turnover certificate, for example, for the purpose of a tender, so many times one has seen clients takes that certificate from you, it's for a tender, but then eventually ends up using it for a bank loan, and then bank loan is disbursed, and tomorrow something the client does wrong, bank comes to you and says we relied on your certificate. Always have that restriction and intention of use paragraph which clearly disclaims any other person should not use it and why you are issuing it for. Two reasons. One, you are limiting your exposure, your risk in terms of only the person for whom you have made that certificate should rely on it, and your client does not misuse the certificate. Put your UDIN certified. And second, for example, if he's going for applying a loan and you have said that this is for the purpose of applying application of loan with SBI, 3 months later the loan doesn't come through, he has to apply it with Bank of Baroda, he should come again to you for a certificate, not just for your commercial reasons, but in fact situations, facts, other things must have changed. So you can then relook at the financials and issue them a appropriate certificate again. So very important guidance note that deals with certificates for special purposes and reports. I would urge all members who have attended this seminar or may be viewing it in the recorded format, please always use this guidance note if you are issuing any report or certificate for special purposes. It is available on the institute's website. It's going to be extremely useful for you. Finally, 2 or 3 important FAQs that are always asked to me in these sessions regarding, well, prospective financial statements, whether you can issue it. This is from the UDIN's FAQs. We have discussed this on prospective financial statements. We discussed clause 3 part 1 of the second schedule, and that what is prohibited, but what you can do is if you can comply with SAE 3400, then you can issue a report along with UDIN on your prospective financial information. Similarly, for compilation of information or provisional financials, clients or entities which are non-auditable, you can issue a report as per SRS 4410. A question is again sometimes asked whether a chartered accountant in practice can issue a certified true copy. There is an income tax return and the client says, please stamp certified true copy, sign, put your CA ka stamp, sikka and give it to me. Well, please be clear, we are not here to stamp and give whatever the client is demanding. First of all, we are not authorized as per the Supreme Court. Only gazetted officers are allowed to true copy a certain document, and we are not gazette officers, and it is not in our interest to just simply stamp a certified true copy and submit it to the client. For example, if the client requires you to certify or attest or provide some assurance, you must always give it with a report. If it's a income tax return that they require you to true copy, I would suggest not issuing a certified true copy stamp. In fact, issue a report along with that or a certificate along with that, stating what is the procedures you have performed. For example, you would have agreed that the total income in that acknowledgement that he has given or the computation you has given agrees with what is present on the income tax website, e-filing India website. Mention the date on which you did the verification and issue a report. So instead of simply stamping certified true copy, my personal advice to you will be, it is advisable that you issue a certificate or a report along with that and don't simply issue a certified true copy. With this, I am just on time because I was given up to 1 PM to discuss this topic. We would like to conclude on the session on certification. We've looked at the guidance notes. On projections, we've looked at the SAE 3400. On provisionals, we have looked at the SRS 4410. I've tried to give you the regulatory perspective of why these are important, why these engagement standards from SQCs, SAs, SREs, that is for historical financial statements, SAEs for prospective information, SRS for compilations and agreed upon procedures are important, why the guidance note is important. We touched upon the role of FRRB, of how we are reviewing financial statements, of why audit standards of like 570 and others are very important for you at FRRB. It is our endeavor that we are able to come out with more and more publications, more and more such events, where today, for example, you are going through the audit standards, then the Ind-AS, and then finally with the Companies Act requirements, and you can stay updated and refreshed. And more importantly, understand from these common errors that if you are auditing such financial statements in the future, these errors and mistakes are not repeated by you. I once again thank the entire team of WIRC for inviting me for this session. Lalit Bhai, all the office bearers, and the entire team at WIRC for inviting me. And I hope with this session, we have been able to clear all your doubts with relation to the certificates, projections, and provisional financial statements. I hand it over back to Sheetal Sharma ji or Shyam Sada ji, whoever is available.
Yes, sir, there is query, but
Sir,
we answered.
Aniket sir,
One of
Aniket.
us is asking, please comment on the main differences between SA 402 and SAE 3402. Hello? Hello?
Yeah,
Sir, there is a query to be answered. Please comment on the main differences between SA 402 and SAE 3402.
no, so the SA 402 deals with the audit when you are doing an audit report and issuing an audit report in terms of an entity which is at a service organization, whereas the SAE 3400 is an assurance engagement. That is to say, you are not doing an audit, but you're only issuing a assurance report. Therefore, the level of assurance that you are doing is different. In audit, you are doing a more thorough verification. It's, for example, in relation to a statutory audit, you have a service organization which is giving you certain reports. In that sense, you will be using the 402. The 3402 is only to provide, for example, the auditor is in a foreign entity and you are only doing certain assurance engagements. In that aspect, the SAE 3402 will be used.
Well, with this, we think we come to the end of our session for this afternoon. With this, I would like to propose a vote of thanks to you, sir. It's indeed my privilege to propose a vote of thanks to such a multi-talented and multi-speaker, CA Aniket, sir. Sir, you have explained this dynamic topic with taking us from basic to each level coming up and explaining the minute details in such an elucidate manner. They say the root of goodness lies in the soils of appreciation for goodness. Each and every explanation which such was so relevant and enriching us with this financial reporting topic and resolving so many dilemmas with the multi using of the languages with respect to attestation, certification, and giving assurances. I'm sure our participants has lot of takeaway from today's session. Your enthusiasm is indeed contagious, sir. As Arpit sir has already said in the morning, that your presence enlightens the seminars. The suggestions given by you, the word of cautions are very timely. I'm sure the hunger with which every member was attending this webinar has been met deliciously. Thank you, sir, for sharing your time and your findings with us on such a dynamic topic, sir. Thank you.
Thank you so much, madam. Thank you, and thank you once again to WRC and all the participants. And I would request all of them to stay online. I believe the next session is at 2 o'clock, where we will be discussing on the Ind-AS non-compliances. Thank you once again.
Thank you, sir.
Afternoon, sir. हेलो सर, माइक म्यूट है आपका, माइक म्यूट है सर। सर ऊपर देखिए रेड कलर का एरो है, जस्ट उसके नीचे माइक ऑप्शन है, ऊपर देखिए, ऊपर सामने सामने आपके सामने सामने, हाँ हाँ, वहाँ पे देखिए कोने में एक रेड कलर का एरो है गो टू वेबिनार का, उसके बाजू में एक वो है माइक ऑप्शन। हाँ बोलिए, हाँ बोलिए बोलिए अभी।
Can I be seen? Everything is okay?
यस सर, यस सर।
Perfect. Eh?
सर हैप्पी बर्थडे सर।
Ah, thank you, Vaibhav. Thanks.
आज आपका बर्थडे है सर।
Thank you. So this is a lunch time right now. People will join later, right?
यस यस सर, यस सर। सर आपका
Okay. How many
पीपीटी
participants? Yeah. Shashi, would you want to upload the PPT? Shashi is my colleague. Yeah. Yeah. I will also.
सर पीपीटी शेयर
Shashi?
करेंगे आपका?
Yeah. He's showing that. Shashi, can you hear me? Shashi?
यस सर, यस सर, यस सर। उनका आवाज नहीं आ रहा है शशि सर का,
हाँ,
क्योंकि
तो उनको भी
मेरे
वही
ख्याल
होगा,
से
म्यूट होगा।
नहीं, म्यूट नहीं,
One
उनका
second.
उन्होंने कंप्यूटर ऑडियो सिलेक्ट नहीं किया है। आपने ऑडियो जैसे कंप्यूटर ऑडियो सिलेक्ट किया ना, उन्होंने ऑडियो सिलेक्ट नहीं किया, डायरेक्ट ज्वाइन कर लिया, अंदर आ गए, तो ऑडियो का ऑप्शन नहीं
अच्छा।
आया। आपको ऑडियो वीडियो आ रहा है, आप पीपीटी शेयर करिए ना सर आपका।
ओके, एक मिनट ना, मैंने आपको वैभव, मैंने WRC के भेज दिया PPT ऑलरेडी आपको।
Afternoon, sir.
WRC को भेज दिया मैंने ऑलरेडी।
पीपीटी भेजा है सर, आप दिखाने वाले पीपीटी है कि नहीं सर?
Yeah, we will be showing.
सर आप स्क्रीन करिए ना सर।
One second, मैं वही देखता हूँ।
Should I do it, Khushroo? Hi.
Shashi, hi. Can you hear me now? Yes.
I can hear you now. I think this
Yes.
audio was facing some issue.
No problem. So Shashi, Vaibhav, our friend from WRC, actually is wanting the presentation to be shared, maybe on the screen.
Sure.
On the screen.
यस सर। सर आप इसको मिनिमाइज कर दीजिए सर, आपका पीपीटी ऑन करें ना पीपीटी।
Good afternoon,
Just one
sir.
second.
Good afternoon. Vaibhav, is it okay now?
पीपीटी फुल स्क्रीन करिए ना सर, फुल स्क्रीन करिए ना।
Okay. Shashi, you will take care of
हाँ
it,
सर,
right?
सर स्लाइड शो पे करिए, स्लाइड शो पे।
Press F5.
Shashi, this is the one with 49 slides, no?
That's correct, Khushroo.
Hello? Yeah.
Yes, that's correct. Sorry, I was on mute.
No problem. Okay. Vaibhav, are you getting the presentation on the screen?
Sir, presentation is there. Now thing is that, sir, you have to make it in full screen mode.
Acha, Shashi, you can make it into a slideshow.
Okay. No, I think it's your screen which is getting displayed, Khushroo.
Oh, is it? Okay.
Yeah.
Oh, that means I have to.
Khushroo, sir,
stop sharing.
you have to stop sharing. So you have to give it to Shashi, sir, right? For
Yes,
screen
yes.
share.
I'll share it. Yes, yes.
Mishra, screen
Give
share
it to
sir
me.
को दे दे, Shashi sir को दे दे.
मेरे से ले लो आप, please. Can you just take away from me? Sorry.
Are you able to see my screen?
Yes, sir.
Is it okay, Vaibhav? Everything is okay now? My rights are taken away now?
Yes, your rights are taken away, sir. We can see the screen of Shashi sir, and it is a presentation on now.
Correct. So, Shashi, is it okay if I request you to flip through? Is it okay?
Sure. I'll do that.
Thank you. Sorry to bother you.
No,
Vaibhav,
no
we are
problem.
not connected with the audiences yet, right, Vaibhav?
Sir, audience are somewhat connected. Some people are out, some people are in, because we have started the program in morning. That's why.
No. Is this particular conversation?
We are not live right now in the session.
We are not live, huh? Vaibhav, we are not live.
Mishra ji, we are live.
Yes, sir.
Live, we are live, sir.
Okay.
So start करेंगे ना अभी?
It's exactly 2 o'clock. Maybe just allow a couple of minutes.
Yeah, a couple of minutes.
शशि सर आपका कैमरा ऑन करेंगे शशि सर?
Okay.
हाँ, ठीक है. Is it better? Am I visible?
In fact, on your window, actually, I can see all my options out there, so I'm not able to see you. I can see Sheetal, so it's okay. Hi, Sheetal. Good afternoon.
Good afternoon, sir.
Good afternoon.
If you click on that upper tab, there is something called as a view everyone. That will allow you to see my camera also. Khushroo.
Right.
शशि सर आपका कैमरा है ना अभी चालू है, पब्लिक को दिख रहा है. पीपीटी ऑन है ना, इसलिए आपका कैमरा आपको नहीं दिखेगा.
अच्छा, ठीक.
कैमरे के पीछे आपका पीपीटी आगे हो गया.
ठीक है, तो मैं कैमरा बंद कर दूं या चालू रहने दूं?
चालू रखेंगे तो भी अच्छा है, बंद कर देंगे तो भी अच्छा है.
ठीक.
शशि सर अभी चालू रखिए ना सर, अभी फोटो ले लूंगा, बाद में बंद कर दीजिए सर.
हाँ जी, एक सेकंड है, मैं खाली हेडसेट पहन रहा.
शीतल मैडम चालू करेंगे.
Good afternoon, all. Welcome to our second session for the webinar on the topic commonly found non-compliance on financial statement prepared under Ind-AS by eminent speaker CA Khushroo ji. Before starting with the technical session, I would like to give brief introduction of Sir. Sir is an FCA with 35 years of experience, a Bachelor of General Law, and holds diploma in insurance from Darden Business Schools from Virginia. Presently, Sir is a senior audit partner with Walker Chandoik and Company LLP. He has extensive experience both locally and internationally in auditing and advising large corporations and MNCs. Sir has profound knowledge of different work exposures, to name a few: corporate governance code, internal control, risk management, public policies affairs, and due diligence. Sir has remarkably has given professionally, educationally, and socially to the society contributed. He is eminent speakers in many seminars, workshops, webinars, locally and internationally. Has also presented papers in India, Singapore, Hong Kong, UK, and USA. Sir is also a visiting faculty at many trainings and management institutes. Sir holds memberships of various institutes. To name a few, Sir is a member of editorial board of Diploma in DIRM of ICAI. Sir is also a technical reviewer at FRRB, that is Financial Reporting Review Board, member of CPE, National Committee on Insurance and Pension, CFOs. Sir is also an independent advisory board of on studies in NMIMS for MBA law. Sir has also contributed as philanthropy to various charitable trust institutes. With this, I would like you to welcome Sir on the board and take the charge. Thank you.
Thank you. Thank you, Sheetal, for that introduction, and my sincere thanks as well to FRRB, WRC, and all of you for giving me this opportunity today to present on common non-compliances which are being observed on general purpose financial statements, which was basically done by FRRB insofar as the Indian accounting standards, or what we call Ind-AS. Before I actually begin the presentation, I would also like to welcome my colleague Shashi Tadwalkar, who works with me. And Shashi is an expert on the subject matter. I just thought that he also should be there as well to give his own experience and insights into some of these very, very important observations made by the FRRB while carrying out the review of the general purpose financial statements. So once again, thank you for the opportunity, and maybe I can start now. Am I completely audible and properly audible to everybody? Thank you. Thank you. So before I actually get into this, this particular endeavor of FRRB currently with WRC, I really appreciate. I had done something very similar 3 or 4 times before when I was talking about more from an Indian GAAP standpoint, and this is more on the Ind-AS front. And this particular endeavor of ICAI FRRB is extremely important given the fact that we all professionals during the course of the audit or for the purposes of financial reporting, when we are finalizing the financial statements, either as accountants or reviewing or auditing them as auditors, we should take into consideration all these discrepancies, anomalies, and errors being observed by the institute FRRB board while carrying out their own review. This particular exercise is extremely well done, I must say, given the fact that there are publications also coming out after this particular review concluded. And it's a learning for everybody, including all of us, as to where these errors are. And guys, as you know, very important is, of course, we as professionals cannot afford to have large errors or significant errors, because that could lead to material misstatements in the financial statements. It could lead to disclosures which could be incorrect disclosures or incomplete disclosures, or to a great extent, and when we will go through the presentation, you could see that many a times on account of the fact that the language being used or the articulation in the financial statements is not appropriate, as a result of which it takes a complete different meaning. And the way the auditors are being observed of late, I think it's important for us to have a complete understanding in terms of what is relevant, very importantly, and where it can be taken into consideration from a overall accounting and a financial reporting standpoint. So with this, let me just sort of put this in perspective. Most importantly, when we are doing the audit of financial statements for any year end 31st March or whatever, it is important for us to take into consideration some of the important aspects of certain standards which relate to recognition and measurement, which relate to presentation and disclosure. And therefore, it's extremely important for us to also read through these particular publications before we get into the finalization mode of auditing or accounting. Friends, before I get again into this particular mode, a couple of important things. There are quite a few publications released by the institute. There are quite a few technical publications on the accounting side and the auditing side. And I keep repeating this again and again, that when it comes to the institute publications or when it comes to audit, our general awareness on the accounting standards is significant, but not on the auditing side. Today, typically, the presentation is more to do on the accounting side and not the auditing side. So we will focus more on the accounting aspects. A couple of other announcements. I would appreciate if at all your questions can be reserved towards the end or towards the conclusion of the presentation that Shashi and I propose to make. And at the same time, I would appreciate that if at all there is anything that you may want to discuss, please make a note, keep a placeholder, and then actually let us know once we conclude this particular presentation. So let me begin this on the another request to the participants over here is the fact that this is only in relation to the errors being observed, and we will take only those specific cases. I would request you to even restrict your questions only in relation to these observations made by the FRRB forming part of this presentation, and not to have your questions across the ocean on any particular topic, because this is not the topic on standards. This is a topic on the errors that have been observed as a part of the FRRB endeavor. And therefore, it is important that you restrict your questions only as far as this particular presentation is concerned. So let us begin this. We will we will go to the very first content slide, and that relates to Ind-AS 1, which is on the presentation on financial statements. Here, I think what I propose to do, and of course, Shashi will be also giving his views wherever I have told him that please chip in wherever you feel it's appropriate or it can be better articulated given his expertise in the subject. But I will spend about a minute or a couple of minutes on every slide, and maybe a couple of more minutes on specific slides which are very, very important, so that you get a full perspective. So over here, when it comes to the presentation of financial statements, let me read out exactly what has been observed, how it was there. The second point is, of course, they're talking about the principles as to which principle governs this particular requirement or the disclosure. And the third, of course, is the observation made by the FRRB as to where things have gone wrong or what is not correct. And that particular observation is the one which is being sort of, reported by the FRRB, and therefore what can be done better or what could be the correct thing is something that we should be aware of. So if you look at it over here, and as I keep mentioning again and again, that the articulation, the disclosures and the presentations of the financial statements is very important. If it is not properly articulated, it definitely misleads the understanding of the users. So here there was a accounting policy in relation to interest income. We all know that the interest income and interest expenditure need to be separately disclosed in the financial statements. Of course, you cannot net it off. Look at the accounting policy. It was noted in the accounting policy that the interest income is shown net of interest expense in the statement of profit and loss. This is not the way, we all know this is not the way that it has to be done or it has to be disclosed. And therefore, it is important for us to be aware as to what should be the exact disclosure. So para 32 of Ind-AS 1 says very clearly that a company should not offset any liabilities or assets or income and expenses unless specifically permitted to do so under the Ind-AS. And therefore, both these things have to be shown at a gross amount and not being netted off with each other. We can go to the next one, please. Specific points where I believe things are very simple for us to understand. We are not spending too much of time, but definitely we'll spend more time on those slides where the content is very important and it can be better elaborated. The second one, again, is in relation to presentation of financial statements only, which is Ind-AS 1. In the notes to accounts in the financial statements, it was observed that a loan had been taken from a related party where the repayment terms have not been stipulated. The loan has been disclosed under the head non-current liabilities. Now look at it over here. First of all, whether it's a related party or a non-related party, we know that the accounting standards cannot make any distinction in terms of lesser disclosures or lesser disclosures or more. In fact, there are more disclosures where related parties are concerned. But of course, over here, the repayment terms have not been stipulated. Now, the fact that this is a loan taken from a related party, one has to have stipulated terms. In the absence of any particular stipulated terms, it is presumed that the loans are payable or receivable on demand, which means that the company which has given the loan actually can call for it at any point of time. Now, the fact that the terms of payments are not stipulated, and the fact that they have not been sort of specified in the accounts, etc., it has still been disclosed as a non-current liability. With due respect over here, even the auditor has particularly missed out this particular point. And therefore, it is imperative that this particular error is well understood by us. And the implications would be that, first of all, you need to make sure that the terms need to be stipulated. And if not, fine, let it be called as a loan payable on demand. These things, if it is again from a related party, sorry, my throat is a little bad, my apologies. In case if it is not stipulated, it is an audit observation. The board of directors should take into consideration what the terms could be. In fact, there should be a resolution to this effect that this is basically a loan repayable on demand. And if it is a loan repayable on demand, it's simple logic that this particular demand would be made at any point of time. It cannot be after 1 year, 2 years, 3 years. It can be any point of time. It can be tomorrow itself, where the lender has a right to call back this particular loan. And therefore, it's extremely important that the disclosure needs to be made separately. Over here, the wrong disclosure is that it is being erroneously disclosed under non-current liabilities. If it is a payable on demand, it is a current asset or a current liability, and therefore it should be classified as a current item and not as a non-current item. Shashi, at any point of time, please feel free to chip in case you believe that some more light has to be thrown on specific items, please.
Sure, Khushroo, please.
Thank you. Let's go further in terms of the errors on account of the standard inventory. Again, over here, the matter is that in the annual report of a company, the accounting policy for inventory. Now, see, these are specific mistakes or these are specific errors in the disclosure in the accounting policies. And even in the past, as a reviewer, I have seen that in many companies, the errors are coming on account of wrong English or on account of less articulation or on account of certain disclosures not being made in line with the standards. I'm not too sure as to what is the purpose of making such disclosures, if at all the compilers of the financial statements believe that, you know, for lack of better words or for whatever, with lesser words, if we are in a position to sort of give some meaning, it is better rather than opening a Pandora's box. But that is not exactly what the standards require. The standards require very, very clear disclosures to be articulated in the accounting policies and in the financial statements. So over here, the accounting policy on inventory was being stated as inventories are valued at lower of cost and fair value. There is a major difference between the word fair value and net realizable value. Although for a common man who is not a chartered accountant, it could mean the same, but in our accounting profession, there is a significant difference between a fair value and a net realizable value. And therefore, when you look at this particular amount, look at this particular error, it gives a feeling that this inventory is being measured at the fair value. Now, the concept of net realizable value is different from the fair value. Net realizable value is something to do with the concept of a company to company valuation of inventory or valuation of an asset, etc. And therefore, it is being used for specific items. Whereas the word fair value is not specifically related to an entity. It is not very entity specific. It could be a fair value for a particular item where this particular value could be generally available in the public, and that is something that could be the best value in the absence of something which is not easily available otherwise. But when you actually sort of do a valuation of inventory, you have your cost available with you, and there is an endeavor and there is an effort to get the net realizable value as of the reporting date. And therefore, if the comparison has to be made between the cost and the net realizable value, it has to be what value that particular item of asset or inventory will fetch in the market, if at all it has to be sold today. And that is exactly what we are trying to say over here, that it is a net realizable value that needs to be compared with the cost and not the fair value, where the fair value normally relates to a financial instrument, or where it is not possible for the market value to be sort of easily determined or net realizable value to be easily determined. At that point of time, you take that into consideration. So if you look at the overall disclosure, it was not correct. And that is where I explain as to what is the difference between a net realizable value and a fair value. We move to the next, please. So this is this particular slide on the same matter, if I go to this slide, which says that inventories are to be valued at lower of cost or net realizable and not the fair value. And therefore, the accounting policy was not correct.
Yeah, Khushroo, I think the observation has been just taken on the next slide. So we can move on to the next one, which is cash statement of cash flows.
Thank you. Surely, thank you. Now, moving to the statement of cash flows, we have actually an error over here where it was observed that the cash paid for purchase of property, plant, and equipment has been simply disclosed in the statement of cash flow as cash flow from investing activities. Now, this is again a very generic head. You are actually incurring an expenditure, a cash flow for property, plant, and equipment, and therefore you need to take that particular terminology into consideration and call the description as acquisition of property, plant, and equipment. Look at this particular error. It is such a simple error. It does not even require any application of mind. When you are actually buying a property, plant, equipment, it says very clearly, and the format also says very clearly that you need to disclose it accordingly. It cannot be capital expenditure. The capital expenditure term is a very, very broad term, of which property, plant, and equipment is only a subset. So when you are acquiring an asset or a property or a plant or an equipment, and of course, you are presenting that in the cash flow, you are required to make that particular disclosure and not just as a capital expenditure. Next, please. Well, this again is in relation to the total amount of repayment of borrowings, which are appearing under the financing activities of the cash flow. So we all know that within the cash flow, as far as the financing activities are concerned, we normally present out there cash flows arising out of financing activities, which could be proceeds from the borrowings and repayments of borrowings on the other side, of course. And normally, one would try and do a reconciliation by way of a proper disclosure in the notes to accounts that the difference between the closing balance of borrowings and the opening balance of borrowings, if at all that is a particular amount, is this tying up with my cash flow disclosure made in the cash flow, or will there be any other non-cash flow items which could be impacting the difference between the opening balance and the closing balance? Over here, it was not coming out properly in terms of the total amount of repayments being made as a difference between the opening and the closing, and therefore the error is that if at all there is any other non-cash flow item or non-cash changes, why is it not being sort of shown by way of a disclosure or by way of a reconciliation in the notes to the cash flow? And this is something that was being missed out, and therefore the observation says very clearly that whenever you have got any payments from the cash flows or any receipts from in the cash flows, and there are some non-cash changes which is impacting the difference between the opening and the closing balance and the items that are appearing in the cash flow, then you need to make the proper disclosure in line with the requirements. So for example, over here, there could be some interest accrued. So normally interest accrued will be shown as an expenditure in the P&L account, and your closing balance of the borrowing, which basically would be your principal amount, and then of course on account of the interest gets accrued, and therefore your closing balance of borrowings could be higher than your actual borrowings, and therefore the difference may not be able to tie up. And this is something where you are required to make that particular disclosure as a note in the cash flow statements. We go to the next, please.
Yeah, so just to add one point here, when this amendment was brought in to these para 44A to 44E, because Ind-AS actually will have several other non-cash items which may have impact on the balance sheet. So for example, conversion of debt into equity, or things like change in control of subsidiary. So either you've lost control or you've gained control. Changes to fair values, changes in foreign exchange rate, etc. So all those will result into the opening and closing balance could be different, even though the transaction itself may not have. So maybe a loan amount has not undergone a change, but in foreign currency, but because of exchange difference, the amount is changing. So what basically Ind-AS requires is that you add a suitable disclosure in the financial statements to enable users understand the difference between opening and closing, and it's not necessary that it will be either a new loan taken or a repayment of borrowing, as the case may be.
Thank you, Shashi. We'll go to Ind-AS 8 now. And within that, of course, there is this particular observation on the accounting policy for leasehold land. And let's read the accounting policy. I think in this presentation, it's very important for you to have your attention on the slide, because this is not just talking about the standard, but it's talking about specific observations, and therefore you should know exactly where things have gone wrong. So here it says that the lease term, the accounting policy was saying that the lease term in respect of the land is about 97 years. The lease term in respect of this land under the finance lease is up to 97 years, with the ability to opt for the renewal of the term and fulfillment of certain conditions. Look at it, I think it's quite open. It is not actually very, very clear in terms of what it specifies. And therefore, it says very much in general. And therefore, the observation of the FRRB over here was that in the absence of accounting policy being properly laid out, the principles, the bases, the conventions, the rules, and the practices applied by the company in preparing and presenting the financial statements and in the recognition and the disclosure requirements of this particular finance lease is not very clear. And if it is not very, very clear as to what are the principles, what are the bases, etc., and all, then you are not in a position to give a proper understanding to the reader of the financial statements. And that's why this particular such accounting policies can definitely even mislead to the understanding of the readers of the financial statements. So what is the level of, in the case of leasehold land, what is the amortization? What is the period of amortization? There's nothing mentioned over here. So that's the error in the financial statements in terms of the disclosure of the accounting policy.
Yeah, I think this observation also is probably relating to the erstwhile Ind-AS 17. As the standard Ind-AS 116 has already become applicable, on the date of transition, the company would need to consider. So obviously under Ind-AS 17, there was this debate earlier whether land leases will be classified as operating versus finance leases. And since this disclosure to demonstrate whether it's an operating or finance lease was not adequate, under Ind-AS 116, the company will anyway need to disclose this lease as per the requirements of the standard. And there is an ITFG to that effect, which is actually giving some more guidance. ITFG 21 in the issue 21, the ITFG bulletin 21, issue number 3 has given more detailed guidance on how exactly to deal with issues on transition.
Thank you. Now going to Ind-AS 12, which is on income tax, again, this particular error is related to a disclosure in the accounting policy, where the accounting policy is just a one-line policy on deferred tax assets and liabilities, where it is stated that the changes in them is attributed to temporary differences. Now you cannot have this one-liner of accounting policy, and therefore the observation actually was that how well the accounting policy should have been presented in the financial statements. Therefore, normally, deferred tax liabilities, which are normally recognized for temporary taxable temporary differences, and deferred tax assets, which are normally recognized for deductible temporary differences. Why? Because over here, if you look at the deferred tax liabilities, your temporary differences will be constituting those which will become payable over a period of time. Whereas in the case of deferred tax assets, it's a reverse situation, where you are going to be benefiting out of those deductible differences. And that particular nomenclature has to come out very, very clearly, not just the deductible temporary differences in the case of DTA, but also what is the carried forward of your unused tax losses, what is the carried forward in relation to the unused tax credits. And therefore, it's very, very important to make a very significant and a very detailed and exhaustive disclosures on how the deferred tax liabilities and the deferred tax assets have been recognized. What are those temporary permanent differences? What could be related to taxable differences? What could be related to the deductible temporary differences? What are your unused tax credits? What are your unused tax losses, etc.? Needs to come out very clearly in the accounting policy for the reader to understand how well these particular items in your balance sheet are being dealt with in terms of the differences in the tax and your differences in the financial reporting. And therefore, this was not in line clearly with AS 12, and therefore this was taken as an error in terms of just a one-line disclosure in the financial statements. Next, please. Now let's come to the observations on Ind-AS 16, which is on property, plant and equipment, what we call as a PPE. The matter over here is that the accounting policy on PPE states that subsequent expenditure, this is the accounting, this is not the standard, please. So I keep on reiterating that this particular first para always in every slide is basically the observation, is basically the disclosure made by the presenters in the financial statements, and therefore that's being picked up as a part of the review. So this accounting policy on PPE states that the subsequent expenditure related to an item on PPE is added to its carrying value only if, it says only if it increases the future benefits from the existing asset beyond its previously assessed standards of performance. So here we are talking about increase, increase. Sorry for my throat, sincere apologies. Any subsequent expenditure you have in relation to a property, plant and equipment is added to the carrying value of the asset if it increases the future benefits arising from the existing asset beyond its pre. Shashi, can you take up the slide, please? I'm having a little.
I will. Sure. Please, Khushroo.
Thank you.
If you look at the requirements under Indian GAAP, for example, you will typically be able to capitalize any incremental expenditure to an existing asset. Typically, that used to be the case when that expenditure results into increase in future benefits from an existing asset beyond its current assessed performance. So, for example, if you've incurred a particular expenditure, that expenditure helps you to increase the production capacity or is able to increase the useful life of that asset as compared to previously assessed useful life. In that case, the expenditure can be capitalized. Whereas under Ind-AS, as you are aware, there is a concept of component accounting, and in situations where it's not necessary that the expenditure incurred results only into increase in future benefit from an existing asset, but Ind-AS actually lays down two primary criteria: that the cost can be measured reliably and that future economic benefits will flow to the company. So just to give an illustrative example, let's say that a company has, let's talk about an airline company, and the useful life of an aircraft is say 40 years. In the 37th year, and a company is replacing the engine of the aircraft. So typically, you will follow a component accounting approach, and you would have amortized the existing engine over its estimated useful life. And if that is amortized, maybe some unamortized portion of cost of that specific asset will be removed from the books, and a new cost can accordingly be capitalized. So therefore, the capitalization of subsequent expenditure, that is what this particular slide mentioned, is on the basis of increase of future benefits from an existing asset. It's the way in which the policy has been worded is not in line with Ind-AS 116, Ind-AS 16. Sorry.
Thank you, Shashi. That was that was absolutely correct, because over here, as you rightly mentioned, that you need to determine that whether it is probable that the future benefits will be flowing to the company. So that needs to be sort of established in your mind, and accordingly only you can capitalize that particular expenditure. So these are the two conditions to be met in terms of reliable measurement and the future benefits flowing. Let's go to the next one, please. Thank you. Okay. This is again a very typical example. And maybe I think over here, we will also demonstrate with an example that, let's say that here the property, plant and equipment states that the depreciation on leasehold improvements is provided over the primary period of lease or over the useful life of the asset, whichever is shorter. Now, the correct or the most appropriate accounting policy should have been that is provided over the period of lease or over the useful life of the asset. Now, just to take an example, let's say that you have a particular lease, which is a period of 30 years, and it is getting renewed twice after a period of 10 years, another period of 10 years, and then you have the last period of 10 years. So when your first renewal period comes after 10 years, that is called your primary period of lease. Generally, the leases in the case of a lease, which could be a lease of property or whatever, normally the lessor will have certain rights and the lessee will have certain rights. And if at all there are certain leasehold improvements being done on that lease in the nature of improvements, etc., in the nature of seeding, in the nature of flooring, etc., and there are certain structures which are being part of it, ideally, one needs to establish what is the real useful life of that particular leasehold improvement. And if at all it is believed that the same leasehold improvement will give them a life over the entire period of lease, which is 30 years, then you can actually amortize those leasehold improvements over a period of 30 years, rather than just being amortizing over the primary period of lease. If you look at the entire objective of having IFRS or Ind-AS is that it gives you that particular leeway. It is not very rule-based. It gives you a leeway to take into consideration the practical aspects and the real life of the assets, and to what extent the benefits from the assets will be flowing in, and to what extent you can use these assets over a period of time. So why should it be only amortized over the primary period and not the term of the lease? And therefore, this particular observation was being taken as an error, since you have that benefit of the lease and to be used over the period of lease, and to then compare it with the actual useful life of the asset. Whichever is a shorter term, you amortize the leasehold improvements over a period of that particular shorter term. And this is something that has come out as an observation from the reviewer, that it should not be just restricted to primary lease. Let's go to the next one. Again, this is a very, very simple, it's a very basic error. We all know that when we are actually disclosing in line with the standards, the movements in your property, plant and equipment, like any other property, plant and equipment, now capital work in progress is also forming part of your property, plant and equipment. And therefore, it was observed that no movement was being shown in the capital work in progress, although the details of other particular items of assets such as PPE have been disclosed by the company. So what had been missed out is that what is the increase or the decrease in the capital work in progress, to what extent the capital work in progress has been further enhanced, what is moved into the PPE, what has been capitalized. Those particular movements have not been shown in line with paragraph 74B of Ind-AS 16. And this was basically an error being observed. And that's why it surfaced and it's becoming a part of this particular presentation and the publication which the FRRB came out with. So if I read the last paragraph, capital work in progress has to be treated similar to like a PPA. It was this particular decision taken by the Ind-AS ITFG group and can be referred from the issue number 33 of the Compendium of ITFGC clarification bulletin. It is also part of this particular clarification bulletin that you need to show the movements in capital work in progress on lines very similar to your other assets forming part of the property, plant and equipment. Coming to employee benefits. Again, it's again, I mean, look at the kind of errors that we are observing under this particular presentation. Most of them relate to accounting policies, and I keep reiterating that because I want to draw your attention that do not ever ignore accounting policies, either as a preparer of the financial statements or as an auditor of the financial statements. Do not ignore thoroughly reviewing these accounting policies on a year-to-year basis, because it could be possible that in the past they may not have appropriately disclosed. It may not have changed. They may remain consistent. But having understood the nitty-gritties of this presentation or even FRRB observations, and the fact that now disclosures need to be much more accurate and much more comprehensive, you need to review those, and wherever there is a scope for a change, you need to make those changes to ensure adequate disclosures being shown. Here it is a matter in relation to defined contribution. I'll just read it out for your benefit, that the defined contribution plans such as Provident Fund, etc., are charged to the statement of P&L when incurred. For certain employees, the monthly contribution for PF is made to a trust administered by the company. Interest payable by the trust is notified by the government. The company has an obligation to make good the shortfall, if any. I mean, it's a very loose and an incorrect accounting policy being shown out there. And therefore, the observation is that if at all the company has any obligation to make good any shortfall, Why do you want to call this as a defined contribution? Because in the case of a defined contribution, the company would not have any such obligations. A company will have such obligations only in relation to a defined benefit plan and not a defined contribution plan. And under Ind-AS 19, such plans are these are defined contribute under this particular standard. Sorry, under this particular standard, this entire disclosure is incorrect, and therefore this is being wrongly called as a defined contribution plan. It is not the obligation of the company to make good any shortfall, and therefore this particular plan is being erroneously called as a defined contribution plan under Ind-AS 19. Shashi, anything you would like to add over here?
So typically in a defined contribution plan, the liability of the company will be over the moment the company has made its contribution, and no further risk, including the risk of interest rate changes or any fluctuations in the fair value of the plan assets that have been invested using such contribution, those will not be the obligation of the company. Now, in this particular case, understandably, the contribution has been made to a provident fund trust, which is administered by company itself, and therefore, the any shortfall in the funds of that particular trust will obviously need to be met by the company itself, and therefore, this will not become a defined contribution scheme, but this will become a defined benefit scheme.
That's right. Going to the next one. Shashi, would you want to take this up? Effects of changes in the foreign exchange rates.
Yeah. So in this particular case, so let's say that there is a foreign operation. So maybe it's a branch or something, and from the review, the FRRB has noted that the exchange difference on monetary items relating to foreign operations are initially recognized in OCI. So typically, under Indian GAAP, for example, there is a concept of integral and non-integral foreign operations, whereas Ind-AS looks at this in a very different manner. Ind-AS will typically look at the functional currency. So understandably, the functional currency of the foreign operation is different as compared to the functional currency of the parent. And therefore, when these balances of foreign operations are getting translated into the reporting currency, the resultant difference, including the difference on monetary items, has been recognized directly in other comprehensive income. Now, what the standard requires is that when this monetary item, say for example, if this foreign operations had taken some loan and the loan balance has been whatever exchange difference that has been resulted, when the loan has been repaid, has been transferred to P&L in this particular case, which is not correct, because the functional currency is assessed at the operations level itself. The exchange differences relating to the reclassification from equity to P&L will occur only when the net investment in the foreign operations has been disposed of, and not at the time when the loan or the monetary item has been repaid. Therefore, this was noted as an error, and therefore the requirements of Ind-AS 21 have not been complied with.
Thank you, Shashi. Let's move to Ind-AS 32. Yeah, a very again, look at the nature of this particular error also. Interest accrued. It is interest accrued, which is being shown under non-financial assets. Very simple thing. What is interest? Interest is a financial item. It is a financial expense or a financial income. Where is the question of this being classified as a non-financial asset? And therefore, I think this is the error which is being pointed out by the reviewer, that it cannot be classified as a non-financial asset. Look, I mean, many a times what happens, like, it just goes without the attention either of the auditor or of the compiler of the financial statements. Everybody knows, including, I'm sure, that, even the students who are studying for the chartered accountancy exam, that what is current, what is not current, what is financial and what is non-financial. So some of these errors are so apparent that they look more like a mistake rather than an interpretation of a statute. Yeah, coming to Ind-AS 38 on intangible assets, again, a very, very interesting observation of the FRRB. I will just read out to you how the accounting policy on R&D is being stated in the financial statements. It says that research and development expenditure is charged to the revenue under the natural heads of account in the year in which it is incurred. Then it says that research and development expenditure on PPE is treated in the same way as expenditure on any other property, plant and equipment. Does it make any sense over here? According to me, it does not make any sense over here. Typically, when you look at the provisions of Ind-AS 38, normally you classify between what is an expenditure on research and what is an expenditure on the development. So you have a research phase and you have a development phase. And we all know for sure that expenditure on research phase has to be accounted as a revenue item immediately upon being incurred. And any expenditure on development phase should be recorded as normally as an intangible item if it is very clear that the recognition criteria has been met in line with the requirements of this particular standard. So that is how this particular accounting policy should have been drafted in the financial statements rather than the one which is being disclosed over here. Very clearly, the difference between a research expenditure and a development phase expenditure needs to come out very clearly. And the accounting of both of these, although in very loose terminology, we call it as a research and development expenditure, but the accounting treatment is very, very different for both. And that particular distinction on the accounting treatment should come out very clearly in the accounting policy. And not only just very clearly, it has to be also sort of, demonstrated in terms of how it is being amortized over a period of time. So this is again an important error which has been observed by the reviewers. Coming to 101, in terms of first time adoption of the Indian accounting standards, this is again a very, very important standard. First time adoption for the companies is, most of the listed companies, of course, is all done. And over a period of time, you will see many entities converging to IFRS or adopting Ind-AS, and therefore there is this first time adoption of Ind-AS over here. And we all know that whenever this particular first time adoption is required, at that point of time, you have got 3 balance sheets, you've got 2 P&L accounts, and then you've got certain items from a disclosure perspective to be much more exhaustive compared to what Indian GAAP had been prescribing earlier. But extremely essential is the fact that your statement of Ind-AS adjustments, which is basically a reconciliation of Indian GAAP and Ind-AS, need to be disclosed in the notes to accounts. It was observed by the reviewer that that particular reconciliation between Indian GAAP and Ind-AS was not coming out in the notes to accounts or anywhere in the financial statements. And therefore, that was being taken up as an error. And therefore, the observation says very clearly that the company should explain how the transition has happened from the previous GAAP to the current GAAP. How did it affect the financial statements by providing a reconciliation of equity, total comprehensive income, and the recognition and the reversal of impairment losses, if any. And this will provide adequate information which will enable the users to understand the implications arising out of the first time adoption on the material adjustments to the balance sheet and to the statement of P&L account. This was clearly a non-compliance, and this can lead to definitely a lot of questions as to how the auditor or how the company did miss out on this very, very important requirement. Next, please. Talking about 103, which is business combinations, again in the annual report of a company, the accounting policy in relation to the business combination was mentioning that the acquisition related costs are generally recognized in the statement of P&L account as incurred. What the observation is that this particular word generally should not be used. It has to be accounted for. And therefore, the reviewer said that The acquirer should account for acquisition-related cost as an expense in the period to which it relates to, and the services are received. Now, we all know that, this particular entire phase of business combinations, when a business combination ultimately gets fructified, when it gets fructified, you have a purchase price allocation, and out of the purchase price allocation, you have got various intangibles those are carved out, and then you either test for impairment or you start amortizing those intangibles. But before that, you incur quite a few expenses on identifying a target, on discussions with a target, on due diligences, legal, etc. These are the expenses which you incur over a period of time. It could take 2 years, it could take 3 years, it could be a shorter period of time as well. So you need to account for this immediately as and when incurred, and it should not be a general practice, but it is a common practice, or it is the practice, it is the law. And therefore, why should you be using this word generally? Why do you want to make such kind of statements in the accounting policies? And therefore, it says very clearly that the language of the policy is not in line with the requirements of the accounting standard. And that's why I keep reiterating that please make sure that the language, the way the things are presented in the accounting policies and the financial statements should be very contemporary and not very fluid, or not something which will give a very different idea and understanding or a misinterpretation to the users of the financial statements. Next, please. Now we come to very, very important standard 107. 107 talks about the financial instruments insofar as the disclosures are concerned. 109 talks about recognition and measurement, etc. So coming to the first observation over here, in the annual report, it was observed that the note on non-current investments contain investments in the equity shares of other companies. So we are talking about non-current equity shares in other companies appearing at the fair value through the OCI. That's what it says out there. Investments in equity shares of some companies, that's an observation, that investments when you have in equity shares with of some companies have been fair value through OCI. Now, when do you fair value through the OCI, and when do you fair value through the P&L account? I think that particular demarcation has to come out very, very clearly. Over here, that did not come out very clearly, and therefore this was not there in line with the requirements of the standard, because it says over here that it was noted that the investments in equity shares of some companies have been fair valued through the OCI. The reason for using this particular fair value through the OCI alternative has not been appropriately disclosed as to why you are actually doing a FPT OCI and not FPT P&L account. This is what the standard actually requires. And therefore, it is believed that the requirement of this particular standard, by not providing that adequate disclosure, has not been made. Shashi, anything that you would like to add over here?
Yes, Khushroo. So basically, as you might be aware that the equity instruments under any equity instruments as financial assets are required to be mandatorily recorded at fair value only. The only exception being the investments in subsidiary associates and joint ventures, which are measured in accordance with the policy choice available under Ind-AS 27. Now, so there is also an irrevocable choice, instrument by instrument irrevocable choice, wherein the company can select to measure certain equity instruments as fair value through P&L or fair value through OCI. And what the standard requires is that para 11A lays down certain criteria that there should be certain disclosures that why you are classifying a particular financial asset as FVTPL and why some as FVOCI. That reason needs to be included as part of the disclosure. And in this particular case, that reason has not been included.
Thank you, Shashi. Let's move on. The next one is something very, very similar and very simple also. Like in the notes to accounts, you have got disclosures in terms of financial risk management. And within that, of course, you have a disclosure on exposure to liquidity risk, where the company had given the maturity analysis of financial liabilities. Now, if you look at the requirements of this particular standard, this particular requirements are very, very stringent. And therefore, the disclosure requirements are also very exhaustive. If you look at some of these balance sheets, especially in the financial service companies which have adopted Ind-AS, the requirements are very, very stringent, and they are very, very thorough, and they are very adequate, and they are very, very exhaustive as well. Now, over here, I think the miss out was not in terms of anything which is to do with the liquidity risk, exposure, etc., as far as the financial liabilities are concerned. But what was missing out was the maturity analysis of the financial assets the company holds for managing the liquidity risks were not being disclosed. Now, in order to manage the liquidity risks arising out of those financial liabilities, what are the financial assets that you have? What are those underlying financial assets you have, and what is the maturity analysis of those assets? Basically, to see some kind of an asset liability matching, like, how over a period of time, whether you have sufficient assets in place, what is the tenure of holding those assets, what are the short-term, long-term composition of these particular assets, how do you ensure that your financial liabilities will be repaid, given the fact that, yes, whether there are adequate financial assets and whether those financial assets will be available at each point of time when those repayments happen. This is very, very important for the reader or the user of the financial statements to be aware of a proper asset liability matching, and in order to ensure that the company continues to be a going concern rather than having any financial crunch. The mere fact that this particular analysis of financial assets underlying the financial liabilities, etc., or on the other side was not really coming out was basically a short of disclosure in accordance with the requirements of the standard, and therefore it's being taken as an error. Thanks. Let's move to the next one.
Yeah, this is the next one.
Yeah, thank you. Here, it again comes to the notes to accounts disclosure regarding some non-current liabilities, where the defaults in the payment of principal and interest. So we all know that whenever there are defaults, insofar as your repayment of liabilities is concerned, you are required as an auditor to make disclosures of these defaults. So it says the defaults in the payment of principal and interest, they have been disclosed in the financial statements. However, from the auditor's report, it was observed that the defaults were remedied before the approval date of the financial statements. Now, over here, you look at it, that during the year, there were certain defaults which was coming out properly in the case of notes to accounts. However, such defaults were remediated subsequently, and therefore, ideally, the company in the notes to account should have actually made appropriate disclosures as to what is the development subsequent to the year end in terms of whether those particular defaults have been remediated or have been corrected or have been sort of ensured that they no longer remain as default. Since they were remediated before the date of approval of the financial statements, they should have been adequately disclosed in the financial statements rather than not being disclosed. Now, from the auditor's report, one could make out that yes, this has happened. Now, when somebody tries to correlate that particular note from the audit report, go into the note and it's not there. In fact, the auditor has gone beyond to say that these have been subsequently done, but the management does not say that, and therefore this is a significant error in terms of the disclosures. And also, what it takes away from the company is that if the company has taken positive steps to rectify the default or to remediate the default, and if it is not coming out properly in the financial statements, actually it will not reflect good on the company. And therefore, one should never miss out of any subsequent events which are happening, both positive and negative, for items or conditions existing on the balance sheet date. And if at all, we need to take into consideration those events, either from an adjustment perspective or from a disclosure perspective, then they need to be very clearly articulated in the relevant notes to accounts, rather than an auditor making a comment on that. So this was a miss out, and that's why it is being taken as an error in the disclosures.
Yeah, and as you also might be aware, this is again a carve out as compared to the IFRS standards. So under the IFRS standards, in case if there is any default in the payment of principal and interest as on the balance sheet date, then so what happens in case of a default on payment of principal and interest, that the entire amount will become due immediately, and therefore this amount ideally should be disclosed as a current liability and not as a non-current liability. The carve out as compared to IFRS under Ind-AS is that if such default is rectified before the signing of the financial statements, before the approval of financial statements, you can take into consideration the subsequent development. Now, as Khushroo rightly pointed out, that disclosure has been made in the auditor's report, but that disclosure is not actually included in the financial statements itself. So technically, if the default was not remediated before the approval date of financial statements, then this entire liability should be presented as a current liability and not as a non-current liability.
Right.
Missing out that fact itself could have jeopardized the disclosure also under the standard.
Thank you, Shashi. Maybe you can take up the next one, please.
Sure. Ind-AS 109 is the standard which talks about classification and measurement of financial instruments. And under Ind-AS 107, the financial assets are required to be classified separately. Now, in this particular case, what has happened is under non-current assets, they have disclosed, the company has disclosed a separate line items saying that receivable from redeemable preference shares. And from another note, it has been noted that this asset is recognized at amortized cost. Now, the Ind-AS 109, which deals with the recognition and measurement, obviously allows recognition of a financial asset subject to the business model test and contractual cash flow test. And if the SPPI test, that is for solely for the purpose of principal in interest, that test has been met, then the asset can be classified as at an amortized cost. So in this particular case, the redeemable preference share, and assuming that the contractual cash flow test has been met because the preference share is redeemable, and there should be an equivalent coupon on the preference share as well, ideally would qualify as a financial asset to be measured at amortized cost. Whereas in this particular case, this has not been disclosed as a financial asset at amortized cost. The corresponding interest income and which ideally should also be disclosed separately as interest income on amortized cost has not been disclosed separately, and therefore there is a non-compliance of para 20 of Ind-AS 107.
Thank you.
Moving on to the Khushroo,
Yeah, please go ahead. Yeah.
Moving on to the next one, in the trade receivables in this particular company, the majority of the amount is due from related parties. Now, this again is a fairly common mistake, that just because the amount is due from a related party, the expected credit loss is provision, or the disclosures related to risk management policies does not include the credit risk disclosures. Just because the parties are related does not mean that the credit risk assessment is not required. So the para 35M of Ind-AS 107 actually requires to assess the ECL provision, expected credit loss provision, and depending on again whether the assets involve a significant financing component or otherwise, the ECL provision will be measured either using the general approach or the simplified approach. And that is what exactly the observation actually says, that the information required by para 35M of Ind-AS 107 regarding the financial asset for which the loss allowance is measured at amount equal to 12 months ECL, or for which the loss is measured at a lifetime ECL, have not been disclosed. So the using general approach, the ECL provision would have been computed. That fact has not been disclosed for related parties. Similar observation is also there on on ECL on the subsequent point, and there is a detailed requirement under para 35A to 35N of Ind-AS 107 relating to financial risk management policies, and those disclosures in this particular case were not adequate, and there are specific discrepancies that have been noted by the FRRB. I'll just read out those discrepancies. It was noted that the method to measure the ECL has not been disclosed, which is not in line with the requirements of para 35B of Ind-AS 107. As I explained earlier, it could be either a simplified approach or general approach using which the ECL provisions will need to be determined. It was noted that the entity's definition of default with respect to trade receivables has not been disclosed. Again, 35B subclause B requires the definition of default. So under Ind-AS standard, there is a comprehensive guidance available in respect of banks, NBFCs in this regard. But for other entities other than the financial services entities, the guidance under the standard of 30 days past due, 30 days DPD is to be used. If that is not used, that's a rebuttable presumption that if what is the definition of default according to company. It is also noted that detailed credit risk disclosure has been given for trade receivables only. It was viewed that non-disclosure of credit risk for other financial assets is not in line with the requirements of para 35H, I, J, K, L, M of Ind-AS 103. So for all assets which are measured at amortized cost and certain assets which are actually measured even at fair value through other comprehensive income, the companies are required to assess the expected credit loss, and related disclosures are required in the financial statements, which was not done in this particular case. Right. Khushroo, you want to take the next one?
Yeah. So I think well articulated, Shashi. The point over here was, of course, any point of time, neither the management of the company nor the auditor should have any kind of a leeway in terms of important disclosures, just because that it's a related party and therefore such disclosures may not be applicable. It could be a slip of mind, it could be a miss out, but equally or rather more stringent disclosures required insofar as the related party transactions are concerned. Therefore, these kind of errors in the financial statements do not speak good about it. Yeah. We're going to 108, right?
Yes, that's right.
Oh, yeah, okay. Now we're talking about segments and disclosures insofar as the segments are concerned. We have a complete different term under the Ind-AS, and look at it. They are no longer called as business segments, they're called as operating segments. If you look at earlier GAAP, which was Indian GAAP, we were talking about primary segment and a secondary segment, and we used to have a business segment or lines of business, etc., as my primary segment, and many a times we will have geographical segments as my secondary over here. But the entire Ind-AS is being sort of taken this completely differently, and they talk about only an operating segment. Now, an operating segment can be a business segment. It can be there as a primary segment, or it can be a geographical segment as well, which can be your primary segment over here within the operating segment. So this particular change of the gap from the erstwhile gap to Ind-AS actually has given you the leeway that now you can decide that what is the operating segment for you, and therefore accordingly you need to make your disclosures appropriately. So over here, if I have to just read out the accounting policy for segment and the note on segment disclosures, that the company has identified business segment as a primary segment as required under erstwhile AS 17. It was viewed that as per the Ind-AS 108, the company has to identify operating segments and to report information for each of these operating segments. And therefore, the disclosures also have to be made in line with this particular segment. What was observed by the reviewer was that the disclosures also were being given by the preparers of the financial statements in line with the AS 17, which was under the Indian GAAP. Coming just to the next slide, on the same point, the discrepancies that were noticed by the reviewer was in terms of reporting of amount under the segment disclosure, whereby the total amount of the segment assets and the unallocated assets was not matching with the total of asset side of the balance sheet. Now, these are very apparent errors in the financial statements. First of all, let's not even, the first point that we were made was that, there was definitely a lack of understanding between a business segment and an operating segment. But the second important error which was observed over here is that even from an arithmetical accuracy perspective, the total segment assets and the unallocated assets did not match with the total assets of the company. And similarly, the total amount of segment liabilities and unallocated liabilities is not matching. So both asset and liabilities from an overall aggregation point did not match with the total amount of assets and liabilities. And therefore, very strictly, the requirements of Ind-AS 108 was not being followed. Segment reporting is extremely very important and to be done very effectively, given the fact that the users of the financial statements should have a clear understanding as to what the company believes are the operating segments, where the business of the company is focused upon. And accordingly, the decision for the disclosures of the segments is driven from that particular aspect. Shashi, you would like to add anything on that?
Yeah. So as Khushroo pointed out, the Ind-AS 108 uses a completely different approach. The way in which the chief operating decision maker reviews the information, and if you look at the requirements of Ind-AS 108, in case if the chief operating decision maker is reviewing numbers which are or the information relating to the operating segments using non-GAAP measures or using numbers which are not GAAP compliant, in that scenario the company will is required to disclose numbers in that particular manner and also provide a reconciliation of those numbers with the financial statements. In this particular case, both have not happened. So Ind-AS 108 uses typically a management approach of reporting segments, unlike the erstwhile Indian GAAP or even Ind-AS earlier Ind-AS, which use this primary or secondary segment as an approach, and business and geography as a class, another classification.
Thank you, Shashi. Going to the next one, I think again a very simple one, where the company is actually having a business activity which only comes under primarily one business segment, and therefore the company thought that from a disclosure standpoint, this particular requirement is not applicable because they operate in only one single primary business segment. And also they make a disclosure, a further disclosure, saying that the company does not meet the quantitative threshold as mentioned under 108, and therefore separate disclosures are not required. Now over here, if at all we just step back and start to think about what this and why this particular disclosure is incorrect, I think it's really incorrect given the fact that just because a company does not meet the quantitative threshold of that 10% or whatever is required, it does not mean that a separate disclosure is not required. There has to be a thorough evaluation by the management and those charged with governance in terms of potentially what could be the upcoming or the most important lines of business, primary segments, or most importantly, again, the operating segments, as to whether those require any kind of a specific disclosure just to thrust upon the readers of the financial statements. And although the threshold from a quantitative standpoint is not met, but the management and those charged with governance, based upon their own assessment, believe that yes, these are one or two focused businesses of the company out of so many other businesses, which definitely will ensure further growth for the company and the focus of the company. Now, just to give you an example, let's say that tomorrow a large, I'm just giving an example. Let's say, I mean, for lack of a better name, a Flipkart, for example. Please don't hold me by this name. But if at all they want to start courier services or some kind of a logistic service, and they want to sort of, inform the readers or the users of the financial statements that this is something that we would want to sort of, focus upon in the future, given the fact that currently everything is virtual, and we believe that e-commerce is definitely going to come up in the future. They may wish to show these kind of segments or businesses, etc., separately, although it may not have met the quantitative threshold. And therefore, I think it's important that such disclosures from a number perspective and from a commentary perspective should be required to be made for better understanding of the by the users of the financial statements. So therefore, I think just because of the fact that it's operating only in one segment and the quantitative thresholds are not being met, it does not mean that the disclosures are not required. That's the point. That's a limited point that the reviewer is pointing out in the assessment that he has made. Thank you.
Yeah, next one. I think next one is similar to
same one. As I was about to say, it's the same one, similar to what we mentioned. I think I've covered both together.
Yeah.
109. Shashi, would you like to take this up, please?
Sure. Uh, so in this particular case, under contingent liability, there is a disclosure that has been given saying that a letter of comfort to the banks has been given by the company against credit facilities availed by subsidiaries and corporate guarantee given to the bank towards credit facilities and financial assistance given to the associates. Just to help you to recap the requirements under Ind-AS 109, a financial guarantee under Ind-AS is whereas under Indian GAAP it becomes more a disclosure and a contingent liability, because the company will be required to meet the liability only when the original facility holder or subsidiary and associate in this case are not able to fulfill that their obligation, and therefore under Indian GAAP this it was considered to be only a contingent liability and accordingly a disclosure. Whereas under Ind-AS 109 and para B 2.5 actually has the specific requirements, a financial guarantee is required to be measured at fair value. And therefore, what the FRRB observed in this particular case is that in both these scenarios, by nature of the item, it is very clear that these are financial guarantees, and therefore these should be disclosed as financial guarantees. One of the significant features of the financial guarantee contract that because there is an obligation to pay a certain specified amount in case if the original credit holder is defaulted. Therefore, you will need to recognize these financial guarantee at fair value in accordance with Ind-AS 109. So therefore, it was viewed that in this case, letter of comfort as well as corporate guarantee is given for to support credit facilities by subsidiary associates should have been recognized at fair value. Now I'll still like to bring in a perspective here. Typically, again, it will depend on the terms and conditions of specific letters. Letter of comfort, or if I can use a slightly different terminology, letter of awareness. Okay, where the company is only not assuming any financial burden or not guaranteeing repayment of loan in case if there is a default by a subsidiary, that will not qualify as that may not qualify as a financial guarantee. Whereas something which has a fallback obligation, a residual obligation coming in case of a default by the original credit holder, will be classified as financial guarantee. And Ind-AS requires typically to measure these financial guarantees at fair value. While Ind-AS does not have a detailed guidance on how exactly to measure this, there are other publications, including some of them by ISB, which provide guidance on the measurement of financial guarantees, or the fair value of financial guarantees. Moving on to the next one, in the annual report there is a disclosure which sorry.
Yeah.
One second. Yeah, in the annual report there is a disclosure regarding loans to subsidiaries, associate, joint ventures, and which reads as follows: in the respect of few of its subsidiaries, efforts are being made to recover the loans. However, due to financial weakness of those subsidiaries, they are unable to repay or regularize the loan. As we discussed earlier,
Shashi, we are not able to hear you. Hello.
Hello.
Hello, Shashi?
Yeah. Sorry, I think there was a electricity failure and my internet
Oh, sorry.
connection was lost.
Okay.
Can
Yeah, we can.
am I audible now?
Yes, please. Yeah, you are.
Yeah. Okay. So in this particular case, ideally the ECL provision should have been recognized on this in these financial assets, and therefore there is a non-compliance of Ind-AS 109 in this particular scenario.
Yeah, please go ahead.
Moving on to the next one, Ind-AS 113. The accounting policy of in this particular case regarding fair value measurement has stated that all the financial assets and financial liabilities of the company has been grouped under level 2. Moreover, the information about the valuation techniques, the inputs used for the fair value measurement has not been disclosed. As you might be aware, the Ind-AS 113 actually has a detailed guidance on fair value measurement, and they classify the measurement in level 1, level 2, and level 3. At level 1 being active market, level 2 based on observable inputs, and level 3 which is based on more complex methods. Now the fact that this was the fair valuation of financial assets and liabilities have been measured, the fair valuation has been done in accordance with based on level 2 valuation, but the related disclosures of fair value hierarchy, a description of valuation techniques, the inputs used for fair valuation, the underlying assumptions, and the related other disclosures have not been included in this particular disclosure. Right. So that is the end of the slides. Quite happy to take up. Khushroo, you want to probably put in?
Yeah, just one particular word for our professional friends over here. I think as everybody would have observed, some of the errors are quite, I would call silly mistakes. Some of the errors are quite basic. And some of the errors which have been observed by the FRRB are emanating from the fact that the understanding of the standards, both in terms of recognition and measurement, and more so in terms of the disclosures, has been lacking. And therefore, I think I would once again like to request everybody that in the Ind-AS world, which is a very, very different world from the earlier GAP, the entire focus and emphasis is on contemporary accounting and the fact that you have a lot of leeway in deciding what your rationale for accounting could be within the standards, provided that you make appropriate and adequate disclosures. And if those disclosures are not coming out well, or if they are not in line with the standards, then these errors can definitely lead to potential misstatements, either under recognition and measurement criteria, or it could be even from a disclosure standpoint. So the most important thing over here would be that after whatever we learn from these kind of events and seminars and the reading of the standards, we need to make sure that we embed in our work approach and in our audit procedures as auditors, and definitely from a preparer standpoint, to take into consideration that these things are rectified in the future financial statements. So with this, we conclude the presentation and look forward to the questions from the participants. Am I audible?
Yes, sir.
Okay.
Any questions from participants?
Yeah, there is one question.
Okay. I'll just read out the question. Under Ind-AS 115 had a reconciliation between old and new standard, but under Ind-AS 116, why it was not mandated as such? So if you actually see the entire genesis of Ind-AS 116, it's a very, very different standard. Previously, if I summarize Ind-AS 116 in a very, very brief manner, the entire operating expense, the rent which was previously charged to P&L as an operating expense, is now been recognized in a similar line to what was the finance lease accounting under the previous standard, and therefore there is no similarity of accounting. So there is no question of reconciliation between the old method and new method. And also the fact that the transition approaches, there are essentially three different options. You can either do full retrospective or you can do prospective, and in prospective also there are two different alternative options. To provide a reconciliation in equity would have, as compared to what was the previous charge, would have been quite onerous, and therefore maybe the standards did not specify that requirement. What is the impact on companies due to FRRB observation? Is the company auditor should restate the financial statements? I think I think somebody else from FRRB, you want to take up this question?
Yeah, this is a question I would reserve it from commenting. I think if I can make my limited comments over here in terms of recognition and measurement criteria being most important, if at all somebody has to do a restatement, I don't think that the review results of the FRRB could lead to this kind of a restatement requirement. Definitely not from a presentation and disclosure standpoint, but if at all there are significant errors, etc., which is being pointed out, then there is a process. But maybe FRRB should be better placed to respond to this question rather than us. Even in terms of the restatement is a decision of the management, depending upon what kind of impact it has on the financial reporting of the prior periods.
Okay. Should I take up the next one?
Sorry. I'm so sorry. I think I mistook this particular question from. I mixed it up with the audit. So yes, let me answer this question. Sorry, I mistook it from the audit standpoint, that whether it results into a new audit report or a restated, a withdrawal of the old audit report. Sorry, man. So yes, if at all it is believed and the management and the auditor agree together that if at all there is an error in the recognition and measurement, and if at all that particular error is significantly to the overall financial statements of the previous periods, then yes, in my humble view, it could lead to restatements. And of course, you know the process of restatements, etc., as to how it needs to be done. And if it is material, then even the auditor has to sort of give his perspective as to whether he would want to emphasize on that particular restatement being done. Yes, so the answer is yes, if it is material, and if the management and the auditors believe that it needs to be restated, then it needs to be restated. I got a little mistaken that whether it leads to a revised audit report or a new audit report. The answer is no. Sorry. Yeah, the third question.
So the next question, third question is that what is the approach to be used in case of prior year errors in form of reclassification and accounting adjustments not recorded in the respective years?
Very clear, restatements. This is a case of restatement, and in Ind-AS there is nothing called a disclosure of a prior period item in the current year. If you believe that certain recognition and measurement criteria have not been followed, which relates to the amounts of the previous years and impacting the results of the previous years significantly, there is no question of any disclosure of prior period items in the current financial statements. It has to lead to restatements. It could be an omission, it could be an error. 108 is very, very clear on that particular front, and you have to follow that. Shashi, please feel free to add your inputs to this.
Yeah. So I think also, so while Khushroo answered that question relating to adjustments and omissions, even any significant reclassifications, you will obviously need to explain them by means of notes. And if that reclassification is in the nature of restatement, so for example, if something which was classified, say gross versus net, reporting, etc., it could still result into a restatement and not necessarily only reclassification. So each of them will need to be evaluated accordingly. Moving on to the question number 4, how would you present a letter of support given by a company to meet the debts of its subsidiary in order to protect the going concern status of the subsidiary? Again, as I explained in the FRRB observations relating to financial guarantee, you will need to evaluate whether this letter of support is in the nature of financial guarantee or otherwise. Some of the criteria that will some of the principles that will be used in evaluating is whether are you assuming a financial or otherwise burden to make good a default by the original credit holder. That will be used. In all scenarios, it will involve a significant element of judgment in the evaluation, and therefore may not be possible to give a case by a generic answer in all situations.
Right. I think question number 5, can we talk about the e-process for annual excellence award for annual reports? We are not here to talk about that. So maybe if somebody from FRRB or someone would want to answer that question, I think I would leave it to that. Question number 6, whether the companies which are picked up for the review are intimated or it's just the FRRB review. FRRB does its review basis the available audited financial statements in the public domain. Again, I would request somebody from the FRRB to respond to this question. I'm not too sure after the FRRB review is being done, whether the companies are informed about some of the errors. I'm not too sure. So again, I would reserve that particular right with FRRB to respond to that question. Question number 7, how do we disclose if there is any earlier year error identified in the subsequent year? We mentioned this before. Shashi also supported that particular question. So there are 2-3 things over here. One is, of course, if you believe that something significantly has been a part of omission or an error in the past, which would have impacted the financial statement significantly then, or if at all there is a wrong reclassification, which could really give a very different view to the users of the financial statements, and that relates to the earlier years, and that needs a reclass, then of course you need to go and restate those financial statements. The management will have to restate the financial statements, and if the impact of the restatement is significant, which it would be, that the auditors would have to think through in terms of what could be the disclosure in the audit report to bring out that particular fact of restatement, which is generally being done by way of a para of emphasis. The next question is there any way, if any listed company wants to review its accounts by the FRRB voluntarily? Again, requesting FRRB to respond to this question. And any common issues noticed in the related party disclosures? I think 3-4 examples which Shashi and I took you through in terms of related party disclosures. Some of these disclosures are not adequate. Some of these disclosures are very discreet and they are very quiet. And we keep on reiterating to the fact that when it comes to related parties, standard disclosures are definitely there. There is nothing that does not require to be disclosed just because it's a related party. This is a very open-ended question. You need to follow the accounting standards in terms of whatever requirements are there from a disclosure standpoint. And how to disclose the provision for expenses not made even after the auditor asked for. Okay, okay. So first of all, let me be very honest. Auditor would only sort of escalate to the management that in relation to these items, your provisions are not adequate. It is up to the management and those charged with governance to determine the impact, definitely to deliberate with the auditor if at all they believe that there is a ground to do that, and accordingly decide as to what they need to do. And if the auditor and the management believe that yes, this is required to be provided for, then they will take it. Coming to your question, where it is very clear from an auditor standpoint that this is something where the liability needs to be provided, or whether the expense needs to be provided for, and if it is not being done, and basis the materiality thresholds and the assessment that the auditor has made, if the auditor believes that the non-provision of such an expense could lead to material misstatement, then the auditor has every right to qualify the accounts. And I'm, in the past, people have asked me some questions that whether it should be reported as a key audit matter, or whether it should be reported as an emphasis of matter, or whether it can be taken as a contingent liability. Answers to all these questions is a simple no. Wherever a provision is not adequate, and if the auditor has escalated the matter to the management, and if the auditor believes that no provision towards this could lead to material misstatements, auditor will have to qualify the accounts. Sorry, give a qualified or a modified opinion, very clearly talking about non-provision of the same could lead to material misstatements. Next question. Maybe we have now, I think we already overboard. Maybe I'll just take a couple of questions and carry for entire trade receivable payable due to business stuck down more than 2 years. How to classify and disclose? I think I mentioned in the beginning itself that let's stick around. I appreciate that these questions are coming, but let's stick around to some of these errors and omissions forming part of the presentation. Any specific comments on COVID specific disclosures? I think, yes, you would have seen a lot of financial statements where the company has given a very detailed disclosure in terms of the impact of COVID on the going concern, impact of COVID on a quarterly basis, and how. But in my view, depending upon industry to industry, the company keeps on assessing the impact of COVID, and the auditor keeps on reviewing the particular assessment made by the management. And after reviewing the assessment made by the management, if the auditor believes that the impact of COVID is still there, or it could potentially have an impact on the going concern of the company, those disclosures definitely will continue, and the auditor may continue making appropriate disclosures then in the audit report, either in the by way of para of emphasis or otherwise. So these things keep continuing. I'm not sure whether we are beyond time, but maybe if the coordinators can let us know if there is any time for further questions, and we can definitely answer to those questions. We're already overboard, I believe.
We do have time for further questions.
Okay, up to what time do we have? 4 o'clock?
Up to 4 o'clock, sir.
Okay, wonderful, great.
Okay. So happy to answer any more questions.
Yeah, I think there is, okay, entire trade receivable payable due to business struck down more than 2 years. How to classify?
So again, this will become, so there is a fairly detailed guidance available, and both the institute has come out with detailed guidances. ISB has actually come out with quite a bit of detailed guidance on COVID related disclosures, and some of these disclosures can be leveraged. There are very good publications that are available. So maybe that's more a generic comment to, again, a lot of questions that are coming up. I think 2-3 steps that companies can do. So while FRRB whether will review voluntarily or otherwise is a separate mechanism, but for the companies itself, there are lots of tools, enablers that are available to evaluate. There are illustrative financial statements under Ind-AS. The WRC itself has published one, and those can be used to assess the adequacy of disclosures. Maybe before you start the year-end reporting process, just getting somebody independently to review the entire disclosures that are required under Ind-AS, whether you complied with, because Ind-AS is a learning process, and I won't say that whether it is from the company side or from the profession in general, anybody can actually step up and say that I know all the disclosures and there won't be any errors that have been made. So to avoid any material errors, it is better you carry out a self-review or use maybe anybody independent to carry out a review, and then assess whether the disclosures are actually in compliance. Also track of new developments, so that's also important. There are changes that are coming in at a regular intervals in the standard. So to track those changes also will be important from your perspective.
Thank you, Shashi. I think one important relevant point, since you mentioned about, somebody mentioned about COVID, and it's a very relevant point. I just wanted to sort of inform our professionals, especially in the audit fraternity, that COVID-19, of course, led to a virtual environment, and we all have worked as auditors in a virtual environment. And all that is, I'm not saying gone and dusted or done and dusted, but to a great extent, even under the current regime, people are working virtually. And although we are much more experienced than what we were as of 31st March 2020, when there was a lockdown phase 1 being imposed, and we all were wondering as to how we are going to be doing the audits or reviews, nothing has changed. Offices are still significantly closed, both from a professional office standpoint and even from the client standpoint. It is only the learnings that we've had over a period of time, and fantastic number of guidances being released by the institute and definitely giving us a lot of guidance in terms of how do we carry out certain audit procedures. But one point which I want to make very importantly is that at any point of time, do not feel that because of this particular pandemic, the pressure is less on the auditors or the pressure is less on the management, and a job done appropriately or accurately to the tune of around 80% or 90% will be kind of a chalta hai. That leeway is not there. So the same rigor needs to be applied on the audit where it is not possible to carry out the normal procedures which you would have carried out. It is important that we carry out alternate procedures. And those alternate procedures would be required to give you a significant level of comfort to determine that, yes, you have got comfort on the assertions underlying the audit. And at the same time, whatever results you would have expected out of the normal audit procedures that you would have carried out, the same level of satisfaction you would have got from those alternate procedures. So again, a heads up to the preparers that just make sure that recognition and measurement and presentation and disclosure principles are well carried out while preparing the financial statements, and more importantly to the auditors, that the rigor of the audit has to be the same or even higher in the virtual environment, given the fact that we will come across difficulties in carrying out the audit, but those difficulties can be significantly addressed by devoting more time, putting more people, and at the same time carrying out additional alternate procedures. Thank you. The next question, I think, since we have time, question number 14, I'll read out for the benefit of everybody. How do we handle arm's length pricing for related party transactions where the transfer pricing report is not available? And the management view is that there are no comparable transactions as these are of spatial nature. So first of all, if the company is subjected to transfer pricing, then definitely I think the transfer pricing reports would be available. You would definitely take cognizance of those reports. You just cannot rely 100% on those reports. Management also will have to demonstrate some more information, and the auditor should also have some kind of an understanding in terms of what could be the other alternates available. But where such reports are not made available to us, given the fact that if there are no alternate comparable sources, my view would be to for the auditor to sort of make 100% sure that is this still not available within our country, whether these kind of specific goods or services are not available. If at all they are not available, what is the practice internationally? And then I think if at all still it is not possible to get the feel about what could be the comparable numbers, etc. and all, I think you need to escalate this immediately to those charged with governance and actually request them to get an expert engaged to give you, if it is material to the financial statements, and if at all it is believed that the pricing with a related party is unreasonable or cannot sort of be relied upon, then they can definitely get an expert being engaged to corroborate on the price that the related party transaction has been entered into. At least as a minimum, that would be required. But if at all you still believe that that is not there, then I think very clearly a disclosure in the audit report, either as a para of emphasis or if it is very, very critical by any other mode, that the auditors have placed reliance and they were not in a position to get any alternate evidence. You just, if it is really material to the financial statements, where a transaction with a related party at a particular value could be significant to the overall operations, and where you believe that this could lead to a potential misstatement, then of course auditor will have to make appropriate disclosures in the report.
Yeah, and Khushroo, they'll also need to consider the implications from a 188 perspective and the company that has that.
Absolutely, yes, and the CARO as well.
Yes.
So that's it. I think from our side, we've. I was under the impression that this is there till about 3:30, but it's there till. I believe the next speaker is already there. So I think with this, we would like to sign off unless there is.
Sir, a question also.
Sorry.
Question or sir.
So there is one more question. The company imported an equipment availing exemption custom duty with an obligation to make export 10 times. After 3 years, company migrated to Ind-AS. What will be the accounting treatment under Ind-AS for past 3 years expired and for future 3 years? Khushroo, you want to take it up or?
You can take it up, Shashi, no problem.
Okay. So basically, there is a company which has given a commitment, and accordingly, if the you'll so this is again the and I probably know the question is coming in primarily because of that guidance on financial guarantee was discussed. So this is not really in the nature of financial guarantee because all what the company has committed to is making certain export. And in case if the exports commitments are not met, the company will need to return the benefit or proportionately return the benefits in of custom duty that they would have availed. So therefore, to my mind, at least a disclosure in the financial statements that such obligation exists should be sufficient. But I'm not certain. But yeah, that's what is my view.
I think we cannot see any more questions now. I think that particular screen is off.
तो हो गया सर.
Okay, ठीक है जी.
Yeah, very thank you, sir. Khushroo sir, very thank you for this good knowledge we got about financial statement and errors we do normally in normal course. So thank you very much for this wonderful session, sir.
Thank you. Thank you to all of you, to the organizers and the coordinators, of course, and for this opportunity. And my special thanks to my colleague Shashi for joining me and also sharing his very valuable experience. And apologies if at all, because of my throat, I had some disruptions. So sorry about that. So thank you once again, and pleasure indeed being a part of this. Thank you. We will log off now. Thanks.
Thank you so much. Thank you.
जयेंद्र सर पीपीटी शेयर करेंगे.
Now we welcome the
फुल स्क्रीन.
next.
तरुण सर आप चालू करिए.
Okay. Now we welcome Mr. N. Jayendran sir. He is managing direct partner of Messrs. Natwarlal Vepari and Company. He is chartered accountant having 30 years of experience in the field of taxation, assurance, and consulting. And now we will discuss about commonly found non-compliance related to Schedule 2 and Schedule 3 of Companies Act. So, Jayendran sir, welcome to the seminar. And now over to you. Sir, you are on mute.
Yeah, thank you. Can you hear me now?
Yes, it is.
Yes, sir.
Yeah, right. So my task is to list out commonly found non-compliances in Schedule 2 and Schedule 3. These are basically as noted by FRRB on their examination of financial statements. I think during the course of the day, someone must have spoken. I think there was a session by the chairman FRRB. He would have told you what FRRB role is all about. So out of that exercise of noting and going through the financial statements, there are some commonly noted non-compliances, and I will take you through some of these. So I'll just broadly touch upon the key concepts to Schedule 2 to Companies Act 2013. Most of you know Schedule 2 deals with the depreciation relating to fixed assets, which is now called property, plant, and equipment. Even Schedule 3 has been modified to call it PPE. So at various places we may have fixed assets, but you have to read them as PPE. So depreciation is a systematic allocation to the depreciable amount of an asset over its useful life. The earlier Schedule 14 listed down the rates of depreciation. The new Schedule 2 lists down the useful life, indicative useful life of the asset. If these useful life are not what the management feels is the useful life of the assets that they have, then they can modify the useful life, but the necessary disclosure needs to be done. and these have to be backed by technical evaluation. It cannot be to the whims and fancies of the management. It has to be backed by technical evaluation and disclosed adequately in the accounting policies for the reader to understand the manner in which the depreciation is being charged and how the amortization takes place. Some of the key changes in Schedule 2 to Companies Act are as follows. Schedule 2 prescribes indicative useful life of various assets instead of the straight line method rates and WDV method rates. So the useful life would remain the same irrespective of whether you have a straight line method or a written down value method. It's just that charge one would be diminishing and one would be equal throughout the useful life. So useful life is a period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by the entity. Companies are allowed to follow different useful life, residual value if an appropriate justification is given. This I have already told you, but you need to not only have technical advice and technical opinion on the same, you also need to adequately disclose in the financial statements that we are depreciating the assets over such useful life. There are no separate rates for double and triple shift. So depreciation is to be increased proportionately for double shift and triple shift as half time, and I think twice for the triple shift. One very important concept is component accounting and the useful life of a significant part of an asset. The classic example which every tutor and every lecturer gives you is the aeroplane, where the engine have a different life, the body shell has a different life, and the seats and the interiors have a different life. So earlier all of them were depreciated as aircraft over the useful life. Now you have to componentize them, and accordingly each component has to be depreciated over its useful life, and over that useful life that component gets amortized, and then when it is time for it to change, the new asset comes into being, whereas the larger asset or the shell may continue for a longer period of time. So this is the concept on component accounting, where cost of one part of the asset is significant to total cost of the asset, and the useful life of that part is different from the useful life of the remaining asset. The useful life of that significant part shall be determined separately. This is called component accounting. Now, what is a component, whether it has a different useful life, is a matter of judgment and assessment, which has to be again based on technical assessment, and accordingly the componentization has to be done. So component accounting is mandatory from 1st April 2015 onwards, and it cannot be restricted to only assets acquired after 1st April or 1st as a case may be. You need to do the componentization even for the existing assets. So having gone through the background of Schedule 2, I would now like to take you through some of the non-compliances noted from the financial statement disclosures relating to Schedule 2. The first one being the accounting policy on depreciation and property, plant and equipment reads as follows. Property, plant and equipment. Depreciation on property, plant and equipment is plotted on straight line method over the useful life and in the manner specified in Schedule 2 of the Companies Act. However, in respect of certain plant and machinery and electrical installation, depreciation is provided as per the useful life assessed on the basis of technical evaluation by the external valuer ranging from 20 to 40 years. Now, most of us seeing this accounting policy itself, I would just like to clarify that I've had a discussion with FRRB on this. These are not hypothetical disclosures. These are actual noted disclosures. So this is the kind of disclosures some financial statements have carried it. And that is the reason why one has to be very careful that we don't repeat such mistakes or such disclosures. From the stated policy, it is noted that a company has used a useful life given under Schedule 2 to the Companies Act. However, in respect certain assets, the useful life as in external value has been used, which range from 20 to 40 years. It was viewed that proper disclosure regarding the useful life of plant and machinery and electricity should have been made with their respective useful life as external value instead of giving a range. So the plant and machinery is a very vast category. It has got different class under the plant and machinery also. So what is 20 years? What is 40 years? Whether electrical installation also is 40 years or 20 years. This is the kind of research is required. So you need to categorize the plant into various subheads and tell that maybe motors are at X number of years and something else is about Y number of years. Z class of assets are over 35 years, and there could be some assets of 40 years. Giving a range like this, the user of the reader of the financial statement does not understand how or which assets are being amortized and how the charge to the profit and loss account is going to happen over the next few years. So this was viewed as not an appropriate accounting policy. From the accounting policy and depreciation given in the annual report of a company, it was noted that management re-estimated the useful life of all assets in 20XX. While comparing the lives estimated by management vis-a-vis the lives indicated under Schedule 2 to Companies Act, it was noted that in certain cases, the life estimated useful are different from the life prescribed under Schedule 2 to Companies Act. So this is all that was mentioned, whereas what are those assets, what useful life has been now determined by the management has not been disclosed. The only disclosure was what has been stated under the case. Now this again, company should disclose the lives used for depreciation of those assets, which is different from the life prescribed in Schedule 2, and it should be supported by technical evaluation advice. The company has neither given such disclosure nor the justification, and even the useful life of all the assets have been provided without any specific disclosure for the useful life, which is different from the useful life in Schedule 2. So in case you're following Schedule 2, you need not specify the useful lives, because for a reference, the reader can go to Schedule 2 and understand what the useful lives are. But in case you are not following Schedule 2 in respect of any kind of assets, the statement cannot be generic and it needs to be more holistic and more specific, where you clearly mention which asset class has got what useful life and whether it is backed by technical evaluation or not. From the note on fixed assets of a company, it was noted that the assets were transferred on April 29, 20XX, but the depreciation charge on those assets was nil. So as you know, depreciation has to be charged for part of the year also. It's only in income tax that the depreciation in the year of sale is not allowed. But in the case of Companies Act, depreciation is to be charged from the date of acquisition and up to the date of disposal. From that perspective, on the basis of this financial statement, on basis of this disclosure, it was noted that depreciation up to the date of transfer has not been provided for, which is not in line with requirement of Schedule 2. So one needs to not only charge depreciation from the date of acquisition, one needs to charge depreciation up to the date of disposal also. Some of the assets of the company were depreciated based on estimated useful life different from useful life. So this is also again similar, that there's no indication which are these assets, whether they are plant and machinery, whether they are building, whether they are computers, whether they are electrical installations, motor cars. There is no indication, whereas the fixed asset schedule must be having classification as per these major classes. So this would again be an inappropriate disclosure and an accounting policy. So because the user would not come to know what is the nature of depreciation and which assets are being depreciated differently. So this is the kind of disclosures which have been noted by FRRB as being inconsistent with the requirement of Schedule 2. And to recapitulate, I'll just mention that the management is entitled to have different useful lives, but if it does so, it has to be based on technical estimates. There has to be categorical statement that has to be technical estimates. As auditors, you're supposed to review those technical estimates. You must at least ensure that there are such technical estimates, and the person making those estimates is technically competent to do it. And having done that, you need to broadly classify which are the assets which have a different useful life, mention those useful lives, and ensure that the reader understands from the reading of this accounting policy which assets are being depreciated different from Schedule 2. If you're only following Schedule 2, there is no problem, because you don't need to reproduce the Schedule 2 rates, because one can refer back to Schedule 2 in the Companies Act. Now I move to the key concepts on Schedule 3 to Companies Act 2013. Schedule 3, as you know, has got two divisions, one relating to Ind-AS financial statements and one related to the previous gap, that is the Companies Accounting Rules 2006 financial statements. So we'll first deal with the Ind-AS financial statements. Schedule 3, read by Section 129 of the Companies Act, describes the format of financial statements, balance sheet, and statement of and general instruction for preparation of same. Format of cash flow is governed by AS3. Schedule 3 of Companies Act replaces revised Schedule 6 with additional requirement for preparation of CFS. Schedule 3 Division 2 prescribed format for Ind-AS compliant financial statements, and Division 1 prescribed format for for the IGAP compliant financial statements. If compliance with the requirement of the Act, including accounting standards, requires a change in the treatment or disclosure in the financial statements, then the changes as per the requirement of the Act, accounting standards shall be made, and the requirement of Schedule 3 shall stand modified accordingly. So, if you know, Schedule 3 is also statute. Now, accounting standard is also statute, because the sections in Companies Act have formulated that this is the accounting policy, accounting standards to be followed. Having done this, if there is a difference in the requirements between what is mentioned in Schedule 3 and what is mentioned in accounting standard, the requirement of accounting standard gets precedence over the requirement of Schedule 3. And to that extent, Schedule 3 shall deem to be modified. And so therefore, if there is inconsistency in any matter between Schedule 3 and accounting standards takes precedence over it. Information related to each item on the face of balance sheet statement to be disclosed in the notes with a cross-reference. Disclosure requirement in Schedule 3 are in addition to and not as a substitution to the accounting standards prescribed under Companies Act. Additional disclosure specified in the accounting standard to be made in the notes to accounts or by way of additional statements, unless required disclosed on the face of the financial statements. All other disclosures as required by the Companies Act to be made in the notes to accounts in addition to requirements set out in Schedule 3. Earlier, consolidated financial statements was applicable only to listed companies. Now, consolidated financial statement is part of the Companies Act, and therefore the requirement of Schedule 3 applies to consolidated financial statements also. So the format is primarily the same, excepting there could be goodwill on consolidation. There will be non-controlling interest in case of Ind-AS financial statements. There is also a requirement of making the specific disclosure of which parent and which subsidiaries contributes what part of the net asset and profit and loss account. That is to be given as an annexure to the financial statement or a part of the financial statements. And consolidated financial statements also are required to be audited, approved, and adopted in the same manner as standalone financial statements. So now consolidated financial statement is part of the requirement of Companies Act, and it is not driven by only listing agreement. So the non-compliance with Division 2 of Schedule 3 of the Companies Act is what I will be dealing with first. One of the key requirements of Schedule 3 Division 2 is that the figures in the financial statement must not be in full figures. If you look at the requirement of Division 2 Schedule 3, it says shall be rounded off as below, and the minimum is hundreds, not the full figure. Therefore, Schedule 3 Division 2 mandatorily requires you not to disclose full figures, and you can start from hundreds, thousands, lakhs, or millions up to a turnover of 100 crores. Beyond a turnover of 100 crores, the minimum is a lakh. So you need to give it in lakhs, millions, or crores, or decimal thereof, and you cannot give it in full numbers, which is therefore the word shall is very important, which is there in Division 2 to Schedule 3. Once a unit of measurement is used, it shall be used uniformly in the financial statements. Therefore, necessary care need to be taken that full figures are not presented, as the words in the paragraph above is shall be rounded off. Now, it was noted, now this is the first of the non-compliance and disclosures regarding contingent liability. It was noted from the notes to account that the corporate guarantees issued to banks and financial institutions has been disclosed under the heading of contingent liability. In this respect, the most first and foremost thing is, if the management has given a corporate guarantee to the banks and financial institutions who have given the loan to them, and it is part of our financial statements, then by disclosing contingent liability of corporate guarantee, it would amount to a double counting. That is the reason why, as per para 8.2.14.1 of guidance note in schedule 2, a contingent liability in respect of guarantees arises when a company issues guarantees to another person on behalf of a third party. Example, when it gives a guarantee for a loan given to a subsidiary or to another company, or gives a guarantee that another company will perform its obligation. However, when a company undertakes to perform its own obligation and for this purpose issues what is called a guarantee, it does not represent a contingent liability, and it is misleading to show that such items as contingent liability in the balance sheet. For various reasons, it is customary for guarantees to be issued by bankers, etc., for payment of insurance, deferred payment to foreign suppliers, letters, etc. For this purpose, the company issues a counter guarantee to its bankers. Such counter guarantee is not really a guarantee, but is an undertaking to perform what is in any event the obligation of the company. Therefore, such counter guarantees are also not to be disclosed separately, because then it amounts to showing double counting and extra contingent liability than what is required to be done. Hence, such performance guarantees and counter guarantees should not be disclosed as contingent liability. So this is very important that you don't double count. If a liability is already there in your financial statements and you are guaranteeing the payment of that, by disclosing such guarantee in the contingent liability, it would amount to a reader who wants to be a skeptic double counting, because there is a liability which you have to pay. You're also showing that I have given a guarantee to pay that. So if one was not to understand, then he would do double counting, that they have double liability on this. That is the reason why you are not required to do it for guarantees taken by for loans and liabilities which is already lying in your balance sheet. It was observed from the said paragraph that such counter guarantee is not really a guarantee at all, but is an undertaking to perform what is in any event the obligation of the company to pay the amount when demanded to, or make deferred payments when due. Hence, such performance guarantee and counter guarantee should not be disclosed as contingent liability. So therefore, these are clearly carried in paragraph 8.2.14.1 and 8.2.14.2 of guidance note on division 2 Ind-AS schedule 3. It was noted from related party disclosure that receivable from redeemable preference shares pertains to an enterprise controlled by the company and it is a related party. However, under the note regarding receivable from redeemable preference shares, the specified receivable has not been classified as due from related party. This again amounts to non-disclosure of a requirement of Schedule 3, for which the paragraph references 8.1.10 of guidance note on Division 2 to Ind-AS Schedule 3. It was observed that loans from related party had been appearing as line item under the notes on long-term borrowings. However, the terms of repayment has not been disclosed. So, Schedule 3 requires terms of repayment and terms of the loans of all the loans. It is not only restricted loan from banks and financial institutions, it relates to all the loans. So as per paragraph 6E1 of General Instruction for Preparation of Balance Sheet, the disclosure for terms of the repayment of term loans and other loans should be made. It was therefore viewed that loans taken from related parties would be covered under the term other loans. Accordingly, repayment term should have been disclosed as per the aforesaid requirement. So you are not to restrict yourself to disclosure of what is there in a sanction letter of a bank, but if you have got private unsecured loans or intercorporate deposits, you are required to disclose the terms and terms of such loans in the financial statement. From the financial statement of the company, it is observed that there are various defaults in the repayment of loans. Further, under paragraph 8 of annexure to auditor's report, the auditor has reported that there has been a delay in timely repayment of dues to banks for ECB and to financial institutions for debentures. And in respect of working capital facility from bank, there has been overdrawing in the account during the year as well as the end of the year. Under remark column, the auditor has reported the status of payment of these defaults, according to which certain dues were unpaid and certain dues were paid before the signing date. Now, in this case, the the observation is the paragraph 8.2.3.6 guidance on division 2 requires separate disclosure for default as on the balance sheet date in repayment of borrowing and interest. However, in the instant case, the details of default remedied before the date of the balance sheet has not been disclosed. So it was disclosed only in the auditor's report, but it was not disclosed in the financial statements, which is not in line with the requirement of Schedule 3. So the defaults existing at the end of the year are required to be disclosed as per Schedule 3, even if they have been remedied before the date of signing of the balance sheet. In this particular case, such defaults which have been remedied have not been disclosed, which is not in line with Schedule 3. It was noted from the notes to accounts that certain amounts of external commercial borrowing is due in the next 12 months. However, no disclosure was found for current maturities of long-term debts under current liabilities. So as you know that a long-term loan, the portion which is due within the next 12 months is required to be carved out of such long-term loan and to be disclosed under current liabilities as current maturities of long-term debt. Now, in this particular case, this was not done, and therefore it was found to be non-compliant with paragraph 8.2.10 of guidance note. The specific paragraph requires presenting current maturity of long-term loan under other financial liabilities grouped under current liabilities. So therefore, care is to be taken that if I have taken, even if I have taken a 10-year loan, every year the amount that is required to be paid, the principal amount, needs to be carved out from the long-term borrowings and needs to be disclosed separately as current maturity of long-term debt under financial liabilities grouped under current liabilities. It was noted that the company has disclosed a one-line item, namely gain on fair value of derivatives under the schedule of other income. It was viewed that the company has not disclosed gain on fair valuation as from instruments categorized as fair value through profit and loss account. So the instrument, the derivative instrument, how it is being accounted and how the gain has come needs to be disclosed. The financial statement should have shown as gain on fair value of derivatives accounted or categorized as fair value through PL. So this was the non-compliance, and as per paragraph 9.2, this ought to have been shown separately. The company under review is engaged in the business of trading and manufacturing of certain goods, and it has its own manufacturing facility. However, in the statement of profit and loss account, the cost of material consumed has not been disclosed separately. Instead, the same has been clubbed under purchase of stock in trade and raw material. Now, if you know that there are three types of disclosure related to material costs in the schedule in the profit and loss statement of profit and loss as per schedule 3. The first item is the cost of material consumed. This is the opening stock of raw material purchases and less the closing stock. Next item is purchase of stock in trade. Now this disclosure under this is to be done only if the company is trading in certain items, that is buying and selling them as such without processing them. If they were being processed, they would go under the first item, which is cost of material sold, cost of material consumed. But if they are not processed, if they're just traded, then they would come in the second category of purchase of stock in trade. Now here the item has to be only the purchase value. Now it's possible that you have opening stock of some items which was purchased last year. There are closing stock of items which have been purchased this year. The changes in this stock is the third item, which is changes in inventory of finished goods and stock in trade. The disclosure has to be done over there. So in this particular case, they had merged the cost of material purchase of cost of material consumed into raw material, and the changes in stock were disclosed in the changes in inventory of finished goods stock in trade, which was found to be not in compliance with the requirement of Schedule 3. The necessary paragraph reference and guidance note is 9.5.1. So most of you must go through the guidance note, as it is quite an exhaustive disclosure document, and it clarifies a lot of items for which we may not have clarity merely by reading Schedule 3. Schedule 3 is like the bare act, and the guidance note is like a commentary where it clears and clarifies a lot of things which otherwise a reader of the pure Schedule 3 may not be able to understand. From the note on other equity, it was noted that there are various reserves. However, nature and purpose of these reserves has not been mentioned. As per paragraph 79 of Ind-AS 1 presented financial statement, an entity shall disclose a description of the nature and purpose of each reserve with an equity, either in the balance sheet or the statement of change in equity or in the notes to accounts. So these AS1 doesn't specify where you need to present it. Based on the convenience and the proper flow of disclosure, they can either be disclosed in balance sheet or the statement of changes in equity or in the notes to accounts. Now, in this particular case, there was no mention of the various types of reserves and what it represents, and this is a non-compliance to Ind-AS 1. Moreover, as per clause C of paragraph 8.2.2.1 given under guidance note on division 2, any reserve other than a capital reserve and securities premium reserve should be disclosed along with the nature and purpose of reserve and amount in respect thereof. The non-disclosures made by the relevant company as above amounts to non-compliance with Schedule 3 guidance note and also with the requirement of Ind-AS 1. It was noted from the financial statement that the significant balance of other advances has been disclosed as doubtful. Now, they have disclosed it as doubtful, but no provision for such doubtful amounts has been made. It is viewed that the nature of these advances has not been disclosed as required under Schedule 3. Further, no provision has been made. So, one mistake which we tend to make is, which we must avoid, is this, that when you give a breakup under any of the item broad heads and on the face of the balance sheet in the notes to the financial statements, we tend to only disclose those items which are founding a place in the Schedule 3 as a disclosure requirement. And at the end of it, a majority of items which don't find a place in the already disclosed captions in Schedule 3 ends up as other advances. Now, the term other advances can only be a residuary one and cannot be a majority one. Now, in this particular case, significant balance of other advance has been disclosed as doubtful. So a reader of the financial statement does not understand what was the nature of these advances which has now been classified as doubtful. Further, having disclosed them as doubtful, you are also required to make a provision, which also was missing. You can't not say that something is doubtful and not make a provision for it, because then you only walk half the path. The first step is to identify doubtful. The second step is to make a provision for the same. If you only take one step, then you have not completed your path. So this is the reason why FRRB had noted this particular item. Disclosed as doubtful. As per Ind-AS 109, a company is required to recognize a loss allowance impairment for expected credit loss on financial assets, including trade receivable. Further, as per paragraph 6b3 of general instructions, allowance of bad and doubtful debt should be disclosed separately under the relevant heads. It is viewed that neither the provision for expected credit loss has been created for doubtful trade receivable, nor the loss allowance has been presented separately by deducting gross carrying amount of the trade receivable. So therefore, the above disclosure, merely by identifying them as doubtful, does not complete the obligation of the preparer of the financial statements, and it is also not in line with the requirement of Division 2 to Schedule 3 and also Ind-AS 109. The next item is relating to financial assets in the form of investment in shares of other companies. These have been disclosed wrongly as inventories. It was noted from the notes to accounts that financial assets in the form of investment in shares of other companies has been wrongly disclosed under inventories. It was viewed that after implemented Ind-AS, investment in shares of other companies falls under the definition of financial assets and should be accounted accordingly. Therefore, it was viewed that disclosure of investment in shares as inventory will impact the true and fair view of the financial statement of the company, as it does not give true picture of financial statements to users of the financial statements. Such inventory, such financial assets, which are, even if they're held for on trading account, are to be classified under financial assets, and you may mention them as financial assets held on trading account, but you should not show them under inventory. classifying for Ind-AS companies, classifying investment in shares as inventory would be incorrect and will not show a true and fair view of the financial statements of the company. It was noted that investment in subsidiaries, associate, joint ventures have been disclosed separately from other than financial assets. So investment in subsidiary, associate, joint venture are by nature financial assets, and therefore they ought to be disclosed under the head financial assets. As per paragraph 8.1.8.4, the terms a subsidiary, associate, and joint venture shall be defined in the respective Ind-AS, Ind-AS 32, 107, and 109. Scope out the interest in subsidiary, associate, and joint ventures that are accounted for in accordance with Ind-AS 110, considered financial statement. Ind-AS 27, separate financial statements, or Ind-AS 28, investment, associates, and joint ventures. However, such investments still meet the definition of financial instruments and are required to maybe represented as a separate line item on the face of the company standard balance sheet, but it has to be under the head financial asset. It cannot be kept outside the class of financial assets. Accordingly, it was viewed that the investment in subsidiary, associate, joint ventures should be considered as part of financial asset shown under the head financial asset as a separate line item in line with the requirement of paragraph 8.1.8.4 of guidance note. It was noted that other bank balances have been disclosed under the head of balances with banks. Further, it is also not noted that the amount is material. Here again, the word is other bank balances without classifying what type of bank balances they are there. It is viewed that since the balance of banks is material, therefore the nature should be disclosed appropriately for the users of the financial statements, as required paragraph 6b. Accordingly, it was viewed that requirement of Schedule 3 has not been complied with. The nature of the other bank balances needs to be shown separately, and just the word other bank balances doesn't reflect, because the word, as I said, any use of the word other has to be a residuary usage and cannot be a primary or significant cannot be primary and cannot have a significant amount. It was noted from the financial statement that fixed assets with banks having maturity period of more than 12 months have been classified as investments. Now, fixed deposit with banks cannot be shown under investments, and they have to be shown under other financial assets and under the caption bank deposit with more than 12 months maturity. So the disclosure under investment would be incorrect, even if the company's objective is to only earn interest on them. From the notes on financial, it is noted that the investment is classified as unquoted investments. The aggregate investment amount and the aggregate impairment value was not disclosed. So in this case, the investment, some of the investment was impaired, but the aggregate amounts of such impairment in value has not been disclosed. Also, the aggregate amount of such unquoted investments has also not been disclosed, which was always there in our previous Schedule 6 also. This has been considered in Schedule 3 also. But unfortunately, in this financial report picked up by FRRB, such disclosure was not there. Under the note on loans as given in the financial statements of the company, the line item appeared as follows: loans and advances to related parties, loans and advances to employees, foreign income receivable, other advances, and interest accrued on FDR. Now, the reason for disclosure of the issue in this is that the word other advances are constituting a significant amount. As I had mentioned earlier, this other advances has to be a residuary portion over here, and it cannot have a significant amount. It was noted that the nature of loans have not been disclosed, whether these are secured or unsecured or doubtful. Further, nature of other advances, which constitute more than 85% of total loans and advances, has not been disclosed. So what is other advance? Other advance must have a category because it constitutes 85%. A user, a reader of financial statement must know, is it a loan to related party? Is it a loan to employees? Is it a loan to others? Is what kind of advance is this? Is it an advance of purchase of land? Is it an advance of purchase of goods? Is it an advance for equipment? What is the nature of advance? So just by writing other advances, it doesn't satisfy the requirement, and one should not get guided by only the captions which are there in Schedule 3. Schedule 3 captions are only an indicative and is not absolute. It was noted from the financial statement that no disclosure has been made about the CSR activity. It was viewed that neither the amount spent nor the details thereof, as it under paragraph 7J of General Instructions for Schedule 2, has not been disclosed. Further, paragraph 11.5 of Guidance Note also have not been disclosed in notes to accounts. As you know, the requirement for disclosure of CSR activity is A, the amount of CSR expenditure that the company is required to spend in terms of the calculation mentioned in section 135 read with the rules. B, under which category or what is the type of CSR activity which has been undertaken as per Schedule 7 of the Companies Act, that also has to be disclosed. Out of which, how much has been spent and how much is pending to spend, that has to be disclosed. So in this particular case, there was no disclosure of CSR activity, although CSR was applicable to them. And that is the reason why this comment has been brought forward to tell everyone that apart from disclosure in director's report, disclosure in financial statements is also required in relation to CSR activities. It was noted from the notes to accounts that deduction of interest on pre-maturity of FDR has been included in the finance cost. It was viewed that deduction of interest income on pre-maturity of FDR should not be accounted as finance cost. Rather, the interest has to be accounted at the net amount. So if supposing you had kept a fixed deposit for 10% for a crore of rupees and you were supposed to get 10 lakhs, but at the end of 9 months, you did a premature withdrawal, because of which they deducted some portion right from day one, you cannot account for 9 by 12% of 1 lakh as gross income and show the deduction as a finance cost. What has to be accounted for is the net amount, net of the recovery of the premature withdrawal as interest income under the head other income. These were the non-compliances noted with reference to Schedule 3 Part Division 2 of Ind-AS, which relates to financial statement as per Ind-AS. I will now deal with the disclosures and non-compliances noted for Division 1 of Schedule 3. So these are the smaller companies, those who are not covered by Ind-AS and are continuing to follow the Companies Accounting Standard Rules 2006. From the share capital disclosure given in the annual report of some companies, it was observed that company has not disclosed rights, preference, and restriction with respect to each class of shares. Even if the company has only one class of shares, which is equity, the rights, preference, and restriction with respect to equity shares needs to be disclosed, because the reader of the financial statement may or may not be conversant with all the terms which an accountant may know. That is the reason why all the rights and preference and restrictions of all class of equity shares shown. Even if you have only one, which is equity shares, what is the equity shares? When you get the money on liquidation, you get the money only on liquidation, you have rights to vote, all those things have to be disclosed, even if there's only one class of share, which is equity shares. Further, reconciliation of each class of shares outstanding at the beginning and at the end of the year was not disclosed. It was viewed that the disclosure of each class of shares with opening, new shares issued, any shares bought back, and the closing. Even if it is opening and closing, you need to write opening, new shares are nil, and closing. So you have to be sure that you do the holistic disclosure of the requirement of Schedule 3. From the share capital disclosure given the annual report of some companies, some of the observation was like this. Under the disclosure regarding shareholders holding more than 5%, it is stated that a company is holding more than 51% shares. However, a specific disclosure regarding shares held by the holding company was not made, which is not in line with paragraph 6AF. So one would say that if he is holding 51%, it is but natural that he is a holding company. So although I may hold 51%, there could be some restriction which a a user of financial statement does not know about. Further, a user of financial statement may not know that if you have 51%, you are a holding company. That is the reason why the separate disclosures have been specified in Schedule 3, and therefore one cannot assume that every reader of financial statement is conversant with all the technical terms which an accountant is supposed to know, and therefore the disclosures have been made with general purpose readers in mind, and all disclosure needs to be done. Unpaid call was shown as receivable without adequate disclosure. It was viewed that gross amount of share capital should be disclosed first, and then calls unpaid should be reflected as a deduction, and net amount has to be shown under the share capital. Similarly, share application money pending for allotment reflected as part of share capital instead of disclosing it as a separate line item after shareholders fund and before non-current liability was not done. Further, reconciliation of each class of shares outstanding at the beginning and the end of the period was not done. It was viewed that a disclosure of each class of shares with opening, new shares bought back, and closing has to be done. So, under share capital, even if you have only one class of equity shares, all the necessary disclosures which are mentioned in Schedule 3 are required to be done. If you have a holding company, if you have an ultimate holding company, then you need to mention how many shares are held by the holding company, how many shares are held by the ultimate holding company. Now, if you have a company who has more than 51%, but there are some restrictions on their voting, then you need to mention that also in the necessary disclosures. From the reserves and surplus disclosures, the following are some of the salient non-compliances. For each of the specified head of reserves and surplus, only the final amount at the end of the period was reflected without showing a movement. So you could see that the last year figure was X, current year figure was more or less than X. So there has been a movement in the reserve. The requirement of Schedule 3 is that you should show opening balance, changes during the year, and closing balance in the inner column. This was not done, and only the closing balances were disclosed. Therefore, this was treated as a non-compliance. Similarly, appropriation from profits for the year were reflected on the face of the statement of profit and loss. Now, earlier, under the old Schedule 6, we had profit before tax, we had provision taxation, then we had profit after tax, and then we had something called appropriated, where we used to write the dividend, where we used to write transfer to general reserve, etc. Now, under the revised Schedule 3, the requirement has changed. Now your profit and statement of profit and loss will have only profit up to profit after tax, which is carried to the reserves. All appropriations, dividend declarations, and transfers to other reserves are now done under reserves and surplus, with the movement being captured separately for each of separate type of transactions. Now, this was not done, and everything was shown on the face of the balance sheet, which is not in accordance with the new requirements. Similarly, debit balance or statement of profit and loss was reflected on the asset side of the balance sheet instead of showing it as a negative reserve under the head surplus. Here also reconciliation of shares was not, and I'm not repeating that because we have already spoken twice on that. So the old Schedule 6 showed debit balance in P&L account on the asset side, but the revised Schedule 3 requires you to show negative reserves so that the shareholders fund, even if it is the losses are in excess of the capital, would be shown in negative, and the liability side would be net of such negative figures. From the notes on long-term borrowing and short-term borrowing given in the annual report of some company, it is observed that secured borrowings include loan availed by creating a charge on the property of a director and his personal security. However, there is no disclosure of such security offered for borrowing. Also, these borrowings has not been classified as secured borrowings. Similarly, current maturities of long-term borrowing were reflected as short-term borrowing instead of disclosing it under other liabilities. So, in the earlier under Ind-AS, I have mentioned the same thing applies here also. The current maturities of long-term borrowings are not short-term borrowings. Short-term borrowings are borrowings which are borrowed for a short term, whereas the current maturities are amounts of long-term borrowing which are now due to be paid within the short term, that is within the next 12 months. That is the reason why reflection of the current maturity of long-term borrowing as short-term borrowing would be inappropriate, and this has been picked up by FRRB. Bonds and debentures will disclose with the type of bonds and debentures and rate of interest only. As per Schedule 6C, disclosure for bonds and debentures should be include particulars of redemption and conversion, and they shall be treated in the descending order of the maturity or conversion date. This one is again on long-term and short-term borrowings. From the note on long-term and short-term borrowing given in the annual report, it was observed that classification of loan as a non-current liability in the previous year, which on becoming a current liability during the current year, the previous year figure has also been reclassified as current, which is not correct. So in the last year, a particular item was due after 12 months. So this was shown as non-current. Come the current year, such amounts are now due in the next 12 months, and therefore they'll be shown as current maturities. Only in the current year will you show it as current maturities. The previous year will continue to be shown as long term. So against long term in the previous year, current year figure will be blank, and that figure would have now moved to current liabilities and shown under the head current maturities of long term liability. A convertible debt instrument maturing after 2 years, where the conversion option for issuance of equity exercisable by the holder at any time has been classified as short-term borrowings. The terms of settlement of a liability do not affect its classification. In the instant case, the maturity for cash settlement was after 2 years, and according the same should have been shown as non-current. So even though the conversion option allows you to have an issuance exercise by the holder at any time, the maturity portion of this is only after 2 years, and therefore this ought to have been shown as non-current and not shown as short-term borrowings. Now this one is regarding trade payables. From the note on trade payables given in the annual report of some company, it is observed that trade payables includes dues payable in respect of statutory obligations like PF, dues towards purchase of fixed assets and other contractual liabilities. Now, the term trade payable is any amount due in respect of goods purchased or services received in the ordinary course of business. Therefore, it is only relating to goods purchased and services received that is trade payable. Any other amount, for example, dues towards capital asset, are to be shown under other current liabilities as a separate item called dues on capital account or capital liabilities payable. And similarly, any of the statutory dues payable should be shown as duties and taxes payable rather than showing them under trade payable. They would, however, all be coming under the broad classification of other current or non-current liabilities. Disclosure relating to provision. Just give me a break, please. From the note on provision given in the annual report of some company, it was observed a valuation of gratuity leave encashment was done by an actuary who provided for current and non-current portion for both. But gratuity was classified as long-term provision and leave encashment classified as short-term provision. Now, this disclosure is not appropriate, and because the actuary based on the data of retirement attrition rate calculates the possible amounts due in the next 12 months as short-term provision and the amount which are not due in the next 12 months based on non-current provision. They use different tables and they use mortality tables and other information of retirement and attrition, basis which they determine how much of it would be due in the next 12 months time and how much will be due beyond 12 months. The portion which is due within 12 months time are marked as current short-term by them, and we are to report these under the respective heads in accordance with the determination made by the actuary. So such determination has to be followed, and changing that determination would not be appropriate. Relating to fixed assets. From the notes on fixed assets given in the annual report of some companies, observed that company having tangible and intangible asset did not categorize the same accordingly. as per paragraph 6I and J, there is a requirement to classify assets into tangible and intangible assets. Further, as intangible assets where the work in progress is disclosed in the capital work in progress, for intangible assets, they are to be disclosed separately as intangible assets under development. So this was not done, and the separate categorization was not done, and all the tangible and intangible assets were disclosed under one table, and without clearly mentioning how much of it is tangible and how much of it is intangible. Similarly, if there are some intangible assets under development, they ought to be shown under intangible asset and development and not clubbed under capital work in progress. Advances given for capital asset are to be shown as non-current advances and long-term loans and advances, and they cannot be shown under the head capital work in progress. Capital work in progress would only relate to those expenditure which have been incurred relating to a project or a fixed asset which are pending installation. Any advance for purchase or construction or of any fixed asset would have to be classified under long-term loan advances as capital advance and not under capital work in progress. Similarly, tangible assets include owned assets such as well as lease assets. No breakup was given in the notes to accounts about the tangible fixed assets which is owned and which are leased. This is especially important for Ind-AS companies now, where there could be right of use assets after application of Ind-AS 116. So care should be taken that necessary disclosure is separately given for those assets which are owned and those assets which are right of use assets. Relating to investments. Investment in associate and joint venture was not disclosed, even though such disclosure was made in the related party transaction. So in the related party transaction, it was observed that there are some associates, there are some joint ventures, because the transactions with them were shown separately in the related party transaction. But the investment by themselves in the investment schedule were not categorized as investment in subsidiaries, associates, and joint ventures with the extent of investment in such entities, and all of them were classified together as investment in equity shares. This was a non-compliance, and care should be taken that such breakups, the financial statement should be consistent with what has been disclosed in different parts of the balance sheet. At one part, you can't be doing right or wrong, and the other part, you can't be doing just the opposite. So if you have considered that particular entities are joint venture or associates, then their primary investment also should be shown as investment in associates or joint venture. Similarly, investment in partnership firm have been included as investments in have included investment in LLP. It is viewed that LLP is a body corporate and not a partnership. Hence, disclosure of investment partnership firm would not include investment in LLP. Such investment should be disclosed separately as other investments, and even the disclosure for the partnership share and the capital balances need not be done for the LLPs. Disclosure regarding inventories. It was observed that from the notes and inventory given the financial statement, trading stock of the company which was into manufacturing and trading activity was included as finished goods and not disclosed separately as stock in trade. So finished goods are those finished items which are manufactured by the entity. Those items which are purchased and sold as such without any process on them are to be disclosed as stock in trade, even though they may be finished goods, because they are finished goods for an entity which is manufacturing, but for the entity who's trading, they are only stock in trade. Therefore, care should be taken that the amount of stock in trade and the amount of finished goods are to be disclosed separately, and their movements also are to be disclosed separately and cannot be merged together. Similarly, there was only one item of goods in transit, whereas the goods in transit included my raw materials, stock in trade, stores and spares. They all were disclosed together instead of showing under each category the amount of goods in transit. The requirement is that goods in transit of raw material, goods in transit of stores and spares, goods in transit of stock in trade are to be shown separately under each category with a disclosure, and they can't be clubbed together as one item of goods in transit. Regarding trade receivable, The requirement regarding trade receivable is that the period of more than 6 months and less than 6 months are to be disclosed with reference to the period that they become due and not with reference to the date of invoices. Whereas in many cases noted by FRRB, the trade receivable were considered from the date of invoice and not from the date they become due. So this care has to be taken that the more than 6 months, less than 6 months under the revised Schedule 3 is as per the due dates and not from the date of invoice. For example, if you have sold something where the amount is due after 9 months, you cannot show the amount as more than 6 months unless after crossing 9 months, they are outstanding for another 6 months. Trade receivable include receivable due from sale of fixed assets and investments. The word trade receivable is receivable on account of goods sold or services rendered, which the company renders. Sale of finished goods is neither goods sold nor are they services rendered, and sale receivable from sale of finished goods are to be classified under other receivable and not under the trade receivable. Here too, care should be taken that if the sale of fixed assets is a significant amount of your class of current assets where you show other receivable, you cannot carry other receivable, but you must write it as receivable on account of sale of goods or sale of fixed assets. So you cannot show just other receivable and include a significant portion of receivable of fixed assets. You should take care to show significant portion under their respective caption. From the note on cash and cash equivalent given in the annual report of some company, it was observed that fixed deposits having maturity beyond 12 months were disclosed under the head cash and cash equivalent. Care has to be taken that fixed cash and cash equivalent will only include amounts on current account and also fixed deposits whose maturity is within 3 months. Fixed deposits whose maturity is from 3 to 12 months will be current assets, and fixed deposits which are beyond 12 months will be non-current assets and shown under other non-current assets. Similarly, as bank balances which have a restrictions in them, for example, they may have been given as a margin or they may have been given as a security, those cannot be classified under cash and cash equivalent. Also, unpaid dividend amounts on which there are no margins are not available to the company and therefore they cannot be shown as cash and cash equivalent. They are available only for the limited purpose of discharge of the dividend amounts and therefore they have to be shown under other balances and not under cash and cash equivalent. In respect of loans and advances, provision for bad and doubtful advances were disclosed in aggregate against all types of loans and advances instead of showing them separately under each category of the loans and advances. The disclosure requirement is that if you have different types of loans and advances and or many of them have got a provision, then each item has to be provided for, because if you have an aggregate provision, then the reader does not know which of the above items have been classified as doubtful, which has an important bearing to the reader of the financial statement. Loans and advances to related parties were not disclosed separately under the head loans and advances, though such disclosures were made in the related party transactions. As per Schedule 3, the loans to related parties are to be shown separately, and not only that, the breakup and the details also are to be given below that the disclosure as additional information. These were some of the non-compliances noted from the various FRRB documentation which has been noted by the FRRB, and I'll be happy to take any questions if there are.
मिश्रा जी कोई क्वेश्चंस हैं? हेलो हेलो मिश्रा जी कोई क्वेश्चन है? No, sir. I think there are no questions. Hello.
Yeah, I can hear you. I'm just waiting
Yes,
if
sir.
somebody's typing or
Yeah, yeah.
posting some.
No, no. I think there are no questions.
Okay.
Yeah. So, so we can conclude this session, or sir, you have something? Any?
No, I have only schedule 2 and schedule 3, and
Okay. Okay. No.
I have somebody covered Caro also.
Yes. Previously it was covered,
Okay, fine.
and
So
I
I have
think there is
already.
some deferment in also in the Caro. So
Yeah, correct, correct. Yeah.
yeah. So anyway, sir, thank you, sir, for sparing your time on Sunday evening,
And
and
yeah,
where
that could be one of the reasons
and
why
you
there
have
are no questions also. Huh?
maybe that's the reason, or but we can see almost 200 people are there, so
Okay.
or there can be the other reason that people are that you have explained so beautifully, sir, that they don't have any questions.
Thank you.
So I think you have covered all of the examples and the background materials which were there, and some of the non-compliances on disclosures which has been highlighted. I think these are very important because some of the things in a regular nature of work we do, and but we unintentionally we do some mistakes. Yeah, we don't
Correct,
realize.
correct, correct.
So
And
these things are
these are
there,
actually
which
these are
that
actually out of
keeps us. It's like that when we
these are actually noted by FRRB, and these are not hypothetical situations. So this kind of disclosure mistakes have actually
correct,
been
correct,
noted
correct.
by FRRB.
Yes, yes. And what happened that it's not that auditor or the company, the person who makes the balance sheet or the person who is reading everything. It is just unintentional mistakes
Yeah, yeah,
which
of
is done
course.
in the balance sheet. It's not that
Correct,
like that, and it just sometime what happened, the fine print or the interpretation of the some particular item and everything is interpreted differently, and it's not only about, and then if nobody points out these mistakes, it just carries on, and then
correct,
suddenly
correct,
you
correct.
discover very later in time. So
And
I
I think
think
that is
these
the
are
whole
very
purpose
important.
of FRRB. That's the whole purpose of
Correct.
FRRB. I think this is the
Yeah.
second such program where I'm speaking. That is the
Yeah.
purpose of FRRB, to highlight to various preparers and auditors to ensure the disclosures
Yeah.
are complete, because ultimately
Correct. Correct.
credibility of financial statement is only when the disclosures are complete.
Correct, correct. And now with the Ind-AS coming, where the disclosures have increased drastically,
Multifold, yeah.
earlier, yeah, earlier it was like, let's say 6 to 8 pages. Now it is 60 to 80 pages. And with these
That's true.
disclosure and with, much transparency to the shareholder, or I can say the stakeholder, it is a very important that we disclose properly and what is required as per the regulation, because even the regulators can see these things in detail, and they can send the notices that you have complied or non-compliant. So it's good for the investors, good for the stakeholder, good for the reader, as well as for the companies and auditor who are making these balance sheet and reviewing and
Correct.
signing this. So thank you,
Correct.
sir. I think you have very
Thank
well
you.
covered
Welcome.
all those topics, and it is
Thank you.
definitely gave a new insight to the topics which have been discussed here. And I'm sure that the participants here will take away something from here, and they will practice in their real life. Thank you, sir, and would
Thank you.
like to
Thank you
conclude the
very much.
session with big round of applause, and thank
Thank
you
you.
from WIRC side. Thank
Yeah.
you,
Thank
thank
you.
you, sir.
Thank
Thank
you.
you.
Right. I just got a call saying that there are some questions to be answered.
सर क्वेश्चन है सर. म्यूट है, माइक म्यूट आपका.
Yeah. So in respect of trade receivable, if we consider 180 days from the due date, then it will not tally with the financial statements. The closing balance of trade receivable as on 31st of the year, out of that, how much of it is more than 180 days from their respective due date, that breakup has to be given. So it will definitely tally because you are supposed to give the breakup of the trade receivable after the financial statements and not what is due after 12 months. You have a closing balance of trade receivable. Out of that closing balances, how much of it is due for more than 180 days from the due date and how much of it is due for less than 180 days from the due date. That is the breakup to be given. Therefore, there is no question of it not tallying with the financials. You mean fixed deposit with banks? So fixed deposit with banks, which are due for within the next 3 months' time, can be part of cash and cash equivalent. Between 12 and 3 between 3 and 12 months is current assets, and beyond 12 months is non-current assets. So fixed assets up to 3 months maturity are part of cash and cash equivalent. So if I understand right, the right term would be retentions. If you mean many government organizations deduct something called security deposits, generally these are paid after the contract period, which is more than 1 year. Should these receivables be current or non-current? So if you mean the retentions which are done by the government organizations, yes, the retentions which are due after the expiry of the contract, if the contract itself is expected to expire after 1 year, and if there is supposing a retention period of 1 year after the expiry of the contract, these amounts will be classified as receivable on non-current basis. In fact, for those who are following Ind-AS 115, these will be shown as contract assets and not even as trade receivable. Because in this contract, because these have still not become receivable because there is still some work to be done, which is the defect liability period is to be fulfilled. Therefore, these amounts will be shown as contract assets under Ind-AS 115. Under ICAI, these will be shown as non-current receivable.
Okay, sir. बस 2-3 क्वेश्चन सर.
Okay.
Thank you, sir.
Thank you.
Welcome.